Thank you very much. I'm John Micklethwait. I'm the editor-in-chief here at Bloomberg. Thank you all very much for coming to the Frontier Forum. I think what is fantastic about this conference and what excites this is really, you look at the frontier economies, you get all the great senses of what matters in history. You get the sweep of demography, you get the importance of politics, you get the influence of technology, and beyond it all, you see these reams of people whose lives may be changed. If you look around the City of London, I was walking in this morning, you look at these great pillars of capitalism around us. Many of those were created and built by people who at the time were investing in the frontier. And the origins of the City of London go back to the fact of people trying at one time to invest in that one-time frontier economy known as the United States. Here at Bloomberg, it is something that as journalists we try to follow throughout the day. You've got Anna Edwards, you've got Justin Carrigan here as well, probably over 100, 150 people working in frontier economies for us, and they are something that sits at the center of so many of the things that we try and want to follow. This is where finance gets exciting, it's where finance gets important, it's where markets matter, and it's where, in a sense, capitalism can change the lives of so many people. And that is the reason why here at Bloomberg we are proud and keen to be involved in events like this. That is all I'm going to say at the beginning. I'm going to hand over to Tran of the Institute of International Finance and then wish you a very good day. But I think this is a very important subject and something which I think is of great interest to everybody far beyond these particular room. So have a very good day and thank you for coming.
Good morning, everyone. On behalf of our co-hosts, Bloomberg and Exotic Capitals, again, welcome and thank you for joining us today. The first event on frontier markets we did together with Exotic Capital 2 years ago in 2016. And since then, we got many requests from our membership to do more and offer more analysis and information in this region. And as a result of that, we are pleased to have this event and opportunity to do this kind of seminar here and elsewhere, but also to bring out a suite of research products. We have copies available for you here. And if you like to have electronic copies, let us know, and we are more than happy to share with you. The theme of our flagship Frontier Market Report is new opportunities, new risks. New opportunities because over the past 4 or 5 years, frontier markets has proven to be a superior asset class. They offer higher return, lower volatility, and lower correlation with the global asset classes. So far, so good. So much so that it has attracted steadily increasing non-resident capital inflow into frontier markets over the past few years. At the moment, last year we tally up about $140 billion inflow, which is a record high, of which $50 billion is portfolio capital flow, buying shares and bonds of frontier market issuers. However, despite the fact that it has grown significantly over the past decade, it is still a very, very tiny part of the overall landscape. The size of frontier market, equity markets, is about $630 billion, which is minuscule compared with the 10.5 trillion market capitalization of the MSCI EM index. For bonds, about 800 billion, which is a very small portion compared with the 21 trillion dollars, this overall size of EM fixed income markets. The other side of these opportunities and progress has been indeed the fact that debt has been steadily built up in many frontier market countries and same as in many emerging market countries. And here, one area that we would like to draw your attention to is the African countries, many of whom, having graduated from the HIPC program a decade or a decade and a half ago, bringing down their sovereign debt to GDP down to below 30%, have increased again their debt to GDP ratio to beyond 61%, which is considered to be a safe level for many developing countries. Some of them have as high as 80–90% debt to GDP. And some of them indeed have already come to the IMF for rescue packages. So to make the long story short, a lot of opportunities, but also new risks. An event like this is designed to share information, to share insight with you, and to help investors navigate this fascinating landscape. With that, thank you very much, and I look forward to learning a lot from our discussion today.
Thank you very much. Thank you, Tran, for the introduction. Thank you to John as well. I'm Anna Edwards. I'm one of the anchors at Bloomberg Television. It's my absolute pleasure to introduce to you Arunma Oteh, who is Vice President and Treasurer at the World Bank, to talk about the World Bank's role, specifically the Treasury's role in encouraging private capital into some of the World Bank's priority areas in frontier markets. We just heard from Hung Tran about some of the opportunities then, the scale of the opportunity in frontier markets, Arunma. I wondered if you could talk to me about some of the very innovative products that you're having to create. I know years ago you talked a lot about green bonds, but now green bonds seem to be, you know, everybody's doing green bonds. So where's the heart of innovation in terms of your efforts to drive private capital into some of these frontier markets?
Well, first of all, thanks Bloomberg-IIF and Exotix for this opportunity. And if you permit me, I think that it's important to set the context for why at the World Bank we focus on two goals: ending extreme poverty and boosting shared prosperity. This morning, 800 million people have not had a meal. 1 billion people have no access to electricity. In sub-Saharan Africa, 2/3 of the people have no access to electricity, and we're talking about my own country, Nigeria, a few minutes ago. About 2 billion people have no access to safe water. And many of these people are in frontier markets. And therefore, our role at the World Bank is to focus on how we can encourage more investing in frontier markets, because I also think that those represent opportunities. And at the World Bank Treasury, even more important that we focus on how we encourage capital to flow into frontier markets. So the starting point for me is that a lot of what we do is dependent on the money that we raise in the capital markets. We raise about $50 to $60 billion a year for one of the flagship institutions of the World Bank Group. And some of that is leveraging green bonds. So if you wanted to, do you want to talk about green bonds or talk about innovation more generally?
Yeah, I mean, talk about green bonds first, and then we can maybe talk about the other, because obviously this is a big asset class now. It started off quite niche, and now it's...
So many of you may be aware that in 2008, the World Bank did its first green bond. And 10 years on, we've done $10 billion, more than 135 transactions in 18 currencies. But I think what is important is our role and the role of multilateral development banks in spurring the growth of a particular asset class. Green bonds are extremely important because they focus on sustainability. It was an asset class that was primarily started by Scandinavian investors who wanted to make sure that the purpose of their funds was actually for green issues. And with the Scandinavian investors, we designed what is basically the process for determining that a bond is green. So one of it is that there is a second party that gives an opinion about that bond. The third is that there is a verification by another party. And most importantly, that you provide reporting on a periodic basis on whether and how you're implementing that particular project. And that's what basically birthed the green bond principles. And today we've got a market that people estimate is about $164 billion. It has utilities, other corporates. It has sovereigns also issuing in this market.
And that's very interesting. So this came out of an interest from money managers to have a way of investing to express that intent. When you talk about other innovative product areas, so I know various crises around the world throw up all kinds of investment opportunities, which you try to tap into. Do they typically is it the sovereign who approaches you for help sometimes, or is it the investor who says, we want to invest in this type of product? So we talked earlier about earthquake bonds, about the Ebola crisis led to product creation at the World Bank. Tell me how these things start.
Yeah. It's all the above. So it could be investors, it could be ourselves at the World Bank, or it could be the countries. And the context is that we manage $200 billion ourselves for the World Bank Group, but also for central banks and official institutions. We have a debt book of $200 billion. We have a derivatives book of more than $500 billion. And so because of our market intelligence, because we stand between an investor, the markets, and countries, we have market intelligence that allows us to try and create products that support the development of countries. So if you take, for example, what we did with the Ebola crisis. So many of you will remember that in 2013, 2014, the Ebola crisis happened. But the world didn't move as rapidly as it should have moved. Because the world didn't move as rapidly as it should have moved, there were more deaths that happened. Development gains were unwound. And so the board of the World Bank said, we need to make sure that if there's a pandemic, that we never have losses, because the world didn't move as quickly. And we worked with the World Bank Treasury, and the health team worked on structuring a standby facility, which meant that we would get premiums from Japan and Germany, and on the basis of those premiums, we would do cat bonds in the market, and which meant that money managers could actually buy high-yielding securities at a point in time when yields were particularly low. It was a 2-year innovation ecosystem that we developed, and in June of last year, we issued the first pandemic bond that basically transfers pandemic risk to money managers. We issued a transaction of $425 million. So that's one example.
Yeah, that's one example, and clearly one that you're very proud of, rightly. When you talk about the interest rate that the money manager was able to get out of investing there, how is that conversation changing as we see the market conversation evolving towards higher interest rates? I know later there's going to be a panel conversation about how frontier markets deal with a higher interest rate environment. Do you find higher interest rates reflected in your conversations when you're trying to persuade investors to put money towards your goals on poverty and sustainable development in frontier markets? Do they say, well, okay, I am interested, but I can get a bit more than I used to be able to investing in roads in the United States now?
I think the conversation is just beginning to happen. But I think what is more important is that diversification for investors is important. Many frontier markets, as Tran mentioned, still offer very high yields. And so what we're hearing more today is that we would like to partner with you as the World Bank Group. We're present in all frontier markets. We're present in most countries. We have a track record of 70 years that we've been doing business in these countries. And some of what we're doing internally is also saying, how can we ourselves make sure that it's not just transactions that we originate for ourselves that are important, but we create an environment that allows the private sector to do business and do well in these countries. So the conversation is slightly different. And some of what I'm saying is that even though yields are rising, you still have $7 trillion of bonds that are negatively that are yielding negative interest rates. And I was teased some money managers, and I said, "Oh, you're paying Germany to be able to give them money. Why don't you think of some of the possibilities that other markets offer?" So the opportunities for diversification, the opportunities for you to earn higher yield, if you have a partner, from amongst the World Bank Group or any of the multilateral development banks is something that people are starting to have a conversation with us on.
It strikes me, talking to you, Arunma, as well, that one of the things you spend time doing is fixing gaps in market structures or in information that investors say they want. So in the green Swedish example you cited. Also, I know that you've just done a deal over in Japan on bonds with the big pension manager in Japan, where there was a lack of information on some of the ESG investment themes that they wanted to get involved with. Are you looking for are you always on the lookout for other investors to work with them on those kind of innovative areas?
Well, so we feel that our role at the World Bank Group is really to de-risk countries, to de-risk projects, and to make sure that the information gap is closed. So the example that you cited of the work that we're doing with GPIF, which is the Japan Government Pension Fund, the largest pension fund in the world, and manage $1.3 trillion, really arose because we saw that there is an understanding of sustainability in respect of equities, but there's not as much an understanding in respect of fixed income investing. And so we decided that we will partner with the largest pension fund and focus on what does it mean to invest in fixed income in a sustainable manner. What are the kinds of returns that you earn? What are the kinds of issues that you look at? What benchmark should you look at? And clearly draw attention to the value of sustainability for the fixed income asset class. Some of what we do, as I said, is to de-risk particular type of transactions. So in certain transactions, we're an intermediary. So a transaction that we did that we priced on the 2nd of February that many of you may have seen was a transaction for 4 Latin American countries, Chile, Colombia, Mexico, and Peru. And it was basically transferring earthquake risk to the markets. It was a $1.36 billion transaction. It was the largest public sector type transaction. It was the first time that you had put together 4 different risks where you could invest in them individually or invest in them together. We have other examples where we help countries and our clients on risk management products. So Tran had talked about the buildup of debt that's happening in many countries in frontier markets. Some of what we do is offer asset and liability management tools to help those countries manage the risk profile of their debt. Yeah.
Yes. Unfortunately, time is running out on us, which is a real shame, Arunma. But when you look at the opportunity for private capital then to get involved with your goals in frontier markets, give us a sense of the scale. If the UN Sustainable Development Goals call for a certain amount of money, and how much is already being ploughed in, and what is the gap?
So we do about $61 billion a year in terms of our own book. If you estimate ODA, what the other multilateral development banks do, probably about $300 billion. And this is a very optimistic estimate. The Sustainable Development Goals require about $4 trillion a year. And some people even say it's $4.5 trillion. So we still need $4 trillion of capital to close the gap. Secondly, I like to cite the example of the bond markets. The bond markets are a $100 trillion market. We have the possibility of taking a little bit if you take 4% of that market, you could actually address the Sustainable Development Goals. And my view is that it's not altruistic. You actually make money and do well in investing in frontier markets. Of course, if you focus on the right kind of partners. And I think that across the multilateral agencies, because we understand the risk of these countries, because of our relationships with these countries, we can provide some of the risk mitigants that you need to be able to do business in this country.
And just finally, Arunma, I know you've the World Bank has recently done some work on wealth of nations, sort of providing a balance sheet for each country to go along with the profit and loss, which is if you like, the GDP calculation. So trying to work out not just what they produce each year in GDP, but also assessing countries based on how much they invest in human capital or in infrastructure and the like. And this threw up the big the underperformance of many sub-Saharan African countries, and therefore the opportunity. Does this remain a big focus of what you're doing, trying to help African frontier markets?
I think that the research that we did on the wealth of nations really draws attention to what is real wealth. And for us, real wealth is what you call produced capital. So what do you do in manufacturing? What do you do in the urban areas? It's also natural resources, which many African countries and many frontier markets have. But most importantly, and what is new, is that it's human capital. And what we showed is that there's a very strong linkage between the investment in human capital and your wealth. And so for countries and frontier markets, for countries that are emerging, really focusing on investing in human capital is key. And so for commodity exporting countries, whether in the Gulf region or on the continent of Africa, focusing on, even if natural resources are wealth, making sure that as you exploit the natural resources, that you're investing in human capital is what we advise. For us at the bank group, that's why we believe that for the world to end poverty, you need to focus on growing the pie, on economic growth. You need to, however, focus on human capital. And most importantly, you need to make sure that countries are building resilience against global shocks like happened with the financial crisis or with disaster risk. And so if we can tackle, and if frontier markets can tackle those three areas, we think that they continue to represent the opportunity for everyone, for investors particularly.
Okay, Arunma, thank you very much. Thanks for your time. Arunma Oteh joining us from the World Bank.
Thank you very much.
And now it's my pleasure to hand over to Dalia. We were just hearing there from Arunma about sub-Saharan Africa and GCC and the importance of managing resource wealth, which is a nice segue into the next conversation around the GCC, Frontiers Oddity. Much time. Never as much time.
You're an expert. Trying to whip through things, right?
Yeah. The time flies.
And I had to do a shout out on what the poverty is. It's big.
Good morning, everyone. My name is Dalia Mirzaban, and I'm a senior editor at Bloomberg covering Europe, Middle East, and Africa. I actually spent a good part of my career living in Dubai and covering the GCC, so the subject of this panel is particularly fascinating for me. Often the term frontier markets, when you think about it, it evokes the image of countries that, while they may not be the least developed in the world, they're too small or too opaque or too underdeveloped in the market infrastructure to be regarded or classed as emerging markets. That's why it's surprising that across the GCC, one of the wealthiest regions in the world, where there is actually a lot of very sophisticated financial infrastructure, that we still have some big countries that are treated in many respects as frontier. Particularly Saudi Arabia and Kuwait. That may be on the verge of changing, and I have a great panel today from the region to walk us through, as it were, some of the shifting sands in the GCC. I'd also like to open the floor for questions, so please jot down any that you might have as the panelists are speaking. We're not really in order here, but I'm going to start with Christophe Roule, who is the Global Head of Research at Abu Dhabi Investment Authority. Before this role, Christophe worked as Group Chief Economist and Vice President at BP, as well as for the World Bank and the EBRD. Christophe, the GCC has some very ambitious plans to diversify the economies. How likely are they to succeed, and what do you see as some of the key economic risks that could blindside investors? One that comes to mind to me is just the boom in shale oil in the US that's about to make America the world's biggest producer.
Yeah, I think it's probably useful to start with the first part of your introduction, so what makes them same or different from frontier markets. And it's like an overlap of three cycles. One is they have these very high per capita incomes, which makes them unlike frontier markets, combined with, for that per capita income, underdeveloped financial markets, particularly debt markets for historical reasons, but also with other things like an endogenous workforce. When you have rapid growth countries there and you have your labor going in and out as you need it, it's very hard to apply our normal concepts such as output gaps or natural rate of unemployment. Things don't apply anymore. So it's very different beasts in that sense. And secondly, of course, when you look at where they're located, I think it's another area of overlap, is fair to say. If you were looking for trouble spots and risky areas in the planet, that must be one of the top areas of neighborhoods which is risky politically. And thirdly, of course, they're all not only oil producers, they're also that category of oil producers which started oil exports before proper sort of institutions were built. And normally those were the candidates which, coming from the oil industry, we would always easily classify as problems with as countries with a subject to petroleum curse or oil curse or resource curse. And so the difficulty which comes with this sudden wealth. And against that backdrop, to answer your question, just a few points to start with. I think number one, it's fair to say, and it's trivial, unfortunately, and nothing new, but they are still oil dependent. So in terms of growth, it's still largely a function of oil prices, has been over the last few years. And we can talk in detail about diversification later. Number two, that means that we have just seen a big decline in oil prices. So how did the adjustment proceed? It's a difficult adjustment, but these are countries with large financial buffers. What we have seen in other oil producers, in particular in frontier and emerging market economies, is an almost universal devaluation across the board. From Azerbaijan at the beginning to Angola fairly recently, everybody devalued its exchange rates. These countries have the financial reserves and the fixed exchange rate system to avoid that. So the entire adjustment is on the fiscal side. And here I think it's important to recognize that this is not the first time this happens. In the oil industry, we had a saying which was cost follows prices. And economists always applied that when prices fell and the boss was crying and investment was cut and everything was impossible. It'd say, don't worry, costs will come down if prices come down, which always happens. Big IOCs have the same rate of return on their capital at 120 oil and 20 oil in the medium term. In some of these GCC economies, I think it's almost equivalent to say that expenditures follow prices. So there has always been historically enough reserves, enough political sort of willingness to ride this out and to bring expenditures down and go through that storm without fundamental changes. Now, the interesting point is that this time around, there are two things potentially, at least, which are probably different. One is the general costs for security, shall we say, in these incredibly bigger economies than they used to be. And the other is the potential costs of things like, the prime example is the reform process in Saudi Arabia. So that will make this adjustment much more difficult for a large number of reasons. And reforms in Saudi Arabia, I would flag maybe another sort of issue we will be talking about going down the road. Having said that, I think we are still in a situation where, unfortunately, the efforts at diversification or so have been less successful than is generally acknowledged. So you can do, I don't want to preempt it now, but just as a hint, when you look at the development of what is called euphemistically non-oil GDP, the classical economist construct. In the GCC, you see the share of non-oil GDP rising over the last 15 years. So by the year 2007, it crosses the 50% threshold, and now it's somewhere 58, 59%. But when you overlay those changes in non-oil GDP with a simple graph showing the oil price, you get an almost one-to-one relationship. Mm-hmm. When you take another example, large economies in the GCC, and you look at energy intensity. So that's, if you look at energy efficiency, energy intensity is how much energy you need per dollar GDP is the best, broadest measure we have. In the GCC, energy is only oil and gas. So it's really oil intensity. It's the only region where this efficiency does not improve. So energy intensity stays constant and increases. And moreover, it seems that with the size of the economy, energy intensity goes up, which means that whatever you create in terms of additional economic structure is more oil intensive than what you already had. These are signs which indicate, and diversification, one should be very clear about this, is an extremely difficult business in the best of times. But these are signs which indicate that the kind of oil dependency will buck them for a long time. And diversification would be a second topic I would flag to discuss. Last one, finally, this is a world where most people in the industry now agree which has a lot of oil, too much oil. It's awash in oil. You can give it any name you want. There is no sort of resource constraint visible for the next 20, 30 years. And just the opposite, this whole discussion of peak oil, we're running out of oil, has just shifted to when people say today peak oil, they mean demand will peak. And that has, of course, sort of triggered discussions. So what happens if the oil price comes under long-term pressure? How far will this adjustment, which is that usually historically was just a fiscal compression of expenditures, how far can this go? And in that context, there's an interesting debate emerging, which I think matters for investors a great deal to understand it. There are some people who say, well, it's an economic game. If there's too much oil, oil prices will be very low. Markets at some point will shrink. Oil demand will start to fall in 20 years or so. And then the low-cost producer, in one sense, is king because he can still produce, but revenues for this particular group of countries will go down, full stop. And there's another group of people who argue no, because actually the costs of producing oil, say in the GCC broadly, is not the $5, $6, $7 it costs to get a barrel out of the ground. You have to add also the social costs, meaning that they will be willing to and also be able to, in the long term, to defend an oil price higher than what the equilibrium price would be. And that sort of would, of course, lengthen the lease on life for the existing business model. Personally, I think if you have this kind of politics versus economics, in the long term, it's economics which wins. But that is a very, very important debate, and you see that emerging and the beginnings of it in this oil market alliance now between OPEC and non-OPEC countries trying to defend the price. So that's a third area I would flag.
Thank you, Christoph. I think that was a great overview of some of the economic risks that we're seeing. I'd like to now talk to Hasnain Malik from Exotix Capital more about political risks. Hasnain is the global head of equity research, and he has more than 20 years of experience in equity markets as a sell-side analyst, covering developed, emerging, and frontier markets. Hasnain, I think a lot of investors are wondering about the Qatar Gulf crisis in particular and how it could impact investments in the GCC. What do you think are the economic costs of a fragmented GCC? And for countries that are perhaps caught in the middle, like Kuwait and Oman and the Emirate of Dubai, what does the crisis mean for their economic stories?
Sure. Well, I think there are a few different dimensions of this discussion. And the points I'd like to make are, first, I think it's a strong case to be made that the embargo, the standoff will continue. I think the second point is it's emblematic of a fragmentation and dislocation across the broader MENA region, Middle East, North Africa region. The third is that, as you say, there are countries caught in the middle of these two quite hardline positions, and there are real economic costs. Dubai, Oman are two examples. Kuwait is another. You could extend it to the likes of Egypt, Pakistan, and Lebanon as well. And then the fourth, I would also say from an investment perspective, is these are not new risks. Actually, these risks have characterized this region for a very long time. And you could argue that equity markets, debt markets are already pricing them in, and actually in some instances pricing them in too much. And there have emerged now some really interesting opportunities for value investors in parts of the GCC, particularly in the equity markets. So let me talk a little bit about those few dimensions. If you look at the standoff itself, you look at the motivations for the standoff, you have on the one side Saudi Arabia and Abu Dhabi, who've adopted a very hardline stance, and I don't see the drivers of that stance changing. Saudi Arabia is grappling with a change of circumstance where the US is no longer regarded as such a reliable provider of security, so Saudi Arabia is trying to take more responsibility for its own security. Abu Dhabi continues to adopt a view that the Muslim Brotherhood is a serious challenge across the region, and is determined to deal with that challenge. Qatar, on the other hand, is caught because on the one side, it shares its largest natural resource with Iran, and therefore has to practically cooperate with Iran. Qatar also has a deep enough sovereign pocket that it can withstand a trade embargo. And also Qatar, like the other GCC states, is very motivated to fiercely defend its own sovereignty and its own independent viewpoint. Those conditions, it's very hard to see what changes that. So I think the first thing is that the embargo is going to be a condition that we live with for some time. The second dimension I mentioned was the fragmentation across the region. This is a split we're talking about within the GCC. But if you look at one of the unfortunate shortcomings of the broader region, if you take MENA as a broadly defined region, it's enough population to match the EU, it's enough sovereign resource, sovereign capital to match China. It clearly has some of the world's cheapest supplies of oil, gas, petrochemicals, plastics. So the potential is massive. The problem is, though, that it is a marketplace with a lack of intra-regional trade. And that has always hamstrung this region from really realizing its full potential from an investment point of view. If you take just one example, perhaps the strongest candidate for a private sector enterprise in the UAE, Aramex, a prime logistics company, has healthily outcompeted the likes of FedEx and DHL. That company, arguably, in the region, should be growing 2 to 3 times as quick as it is, but it struggles because there's an embargo for traded goods going out of Dubai towards the likes of Qatar. There is dislocation and regional disruption in places like Syria, Yemen, Libya, which constrains how quickly that logistics network should be growing. The third aspect I talked about was the countries caught in between. If you take the example of Oman, Oman's a country that arguably could have a much more powerful industrialization story if it was able to bring in Iranian gas. It signed a contract for that gas almost 5 years ago, but it struggled to find a contractor willing, under the current financial sanctions regime, to construct that pipeline. You take the example of Dubai. Dubai is a country that, where its economy relies on trade, transit, transport, tourism. Clearly, if you look at one of its dual assets, DP World, the port of Jebel Ali could be growing significantly faster if we had greater integration. We didn't have this embargo. If you look at the off-plan real estate market, it's a challenge when you see a place like Dubai, which historically has opened its arms to pretty much any type of investor and resident, having to, at short notice, evict citizens of certain nationalities. That's a concerning precedent for that real estate market. Now, for a long time, as long as there is trouble in the region, Dubai will continue to enjoy this inflow of refugee capital and high net worth individuals, but that's a concerning precedent. If you look at Kuwait, it's not really an economic cost, but it's a political risk. Kuwait has a unique political structure where parliament enjoys specific sovereignty in that political system, but parliament's highly fragmented. And there are interests represented in that parliament that the government or the royal family relies upon for its cooperation that may not be comfortable with a hardline stance adopted against either Iran or the Muslim Brotherhood. And that's just 3 examples in the GCC. There are others, as I mentioned, Egypt, Lebanon, Pakistan, who are all sucked into this, finding it difficult to navigate a middle path between these 2 very hardline stances. And then just to finish, in terms of the actual investment implications, As I've said, a lot of what I've just discussed is not brand new. It's not a shock anymore. We've been through some pretty seismic changes and reassessments of risk profile in this region. It's quite interesting that if you look at equity markets, for example, across the GCC, in an environment of rising US rates and concern about how quickly those rates may rise, actually there's some pockets of really interesting opportunity for, broadly speaking, frontier and small emerging market investors. You take one example, which would be the banks across the GCC, perhaps the most leveraged play to rising US rates for an entire global frontier portfolio. So it's not as if this is a new theme for financial markets, and actually you could argue it's been overly discounted in some cases.
Thank you very much. Before we go to our next two panelists, I actually just wish to turn to the audience for a moment. Oil is absolutely tremendously important for the region. And we have seen a recovery in oil prices in the last couple of years. Brent is currently trading at about $65 a barrel. And I'd like to ask whether you think it's more likely that oil will rise 15% to about $75 a barrel or fall 15% to about $55 a barrel. So which of those two scenarios is more likely? So a show of hands on who thinks oil is more likely to rise. Over what period of time? Let's say in the next year or so.
Never put a forecast in that
time. I don't know, really. I guess it's more just a medium-term sort of question. So who thinks it's more likely to rise? Okay. And more likely to fall? Okay. It looked about 50-50, so I'm not, I think the point, though, is that oil prices are so important to the GCC. We've had, several years of budget deficits, and really, even where they are now, and even if they rise, they're not necessarily going to be high enough to balance budgets. So there is such an importance for not failing in diversification, and we've already heard a little bit about the challenges. So our next two panelists have a really close-up view of this. I'm going to start with Mazen and Nahid. Mazen is the Group Chief Executive Officer of Kuwait Finance House. He's also a board member of Kuwait Turk Participation Bank, and he has 24 years of banking experience. Mazen, Kuwait is still a frontier market in many investors' eyes. Do you think there's value in seeing Kuwait and perhaps Saudi Arabia as lower risk countries that potentially have been wrongly placed? Or why or why not?
Well, thank you, Dalia, and thank you for Bloomberg and Exotix Capital for the invitation. I do think that Kuwait and Saudi Arabia, specifically Kuwait, has a much better fiscal situation when you talk about oil prices being where they are today and the potential moving forward for having budget deficits. Adding to that, the reforms that happened over the last 2 to 3 years, those reforms were geared towards diversifying away from oil GDP. Oil GDP represents around 50% of Kuwait's total GDP, and it represents around 90 to 95% of exports out of Kuwait. So during the fall of oil prices, there was, across the GCC, a major move to reform subsidies, particularly because they were draining a lot of the fiscal budget. Reforms in terms of moving away from the public sector and moving into the private sector, trying to encourage more investment into the private sector for long-term investment to ensure that employment takes place in those institutions where it is more efficient, like the point mentioned earlier about how inefficient energy utilization in the GCC, a significant portion of it, and I can give you an example of a PPP project in Kuwait that was done about 2 years ago, and the electricity provided by the government. The cost of the PPP project in relative terms is more than 60% cheaper. The reason behind it is the overhead does not have to take into account the social problems that the country has to employ people, and as such, raising the costs of such services. Adding to that, Kuwait started opening up for foreign investors to start to have 100% ownership in the country as an establishment rather than going through a local partner, if you will. Third element is the development of the capital markets, particularly on the transparency, the establishment of the CMA, having clear governance rules that would ensure clear disclosure by any publicly traded company, making sure that we are very transparent with our investors. Very recently, Kuwait was added to the MSCI Emerging Markets Index and by FTSE Russell, and that step is putting more pressure on Kuwaiti publicly listed companies to have regular disclosures on a quarterly basis with investors, being as transparent as they can, show them how things are developing in those businesses. Moving forward and looking at Kuwait's 2030 vision or 2035 vision, it will rely on multiple pillars. For example, investment in healthcare, in education. These are two of the main pillars for growth. We at Kuwait Finance House have exposure to healthcare, and we are currently investing more in healthcare-related businesses. We're seeing more services industries coming up. There is a huge drive towards SME support. There was a program that was enacted, I think this is the third program, to support SMEs with a value of about $6.5 billion. The idea is to shift employment from the public sector into the private sector and encouraging entrepreneurs to basically drive the country forward and drive the employment moving forward. There are other reforms, such as the removal of subsidy, which took much slower pace in Kuwait in comparison with other GCC countries. And I think the point is, like my colleague earlier said, is we have a parliament, and parliament tends to intervene and make sure that whatever is populous is actually what's being approved rather than what's good for the country in the long term. But I think that's a function of having a strong government with clear agenda that they would be pushing with Parliament and moving away from issues that would or that are populist but unfortunately not good for the country for the future. The last element is Kuwait is blessed, since 1976 of the establishment of the Future Generation Foundation. It is estimated that the total value of it is about $600 billion. That amount last year returned in excess of $40 billion in terms of investment return. If you look at oil GDP, that was $36.5 billion. So it actually exceeded oil GDP as investment GDP. But that is not even looked at in the fiscal budget. So when you add all of that, we do not see any short-term, potentially even medium-term government true budget deficits. They could be financed internally without tapping the international markets per se. So I think that Kuwait is in a much better position when comparing it with other GCC jurisdictions, whether it's in the price of oil and what have you, price of extracting oil and all the others. Next is what Kuwait is moving into and investing heavily in is becoming a petrochemical hub. So we've seen the implementation of the Clean Fuels project, which was approved about 2 years ago. That project will cost about 4.3 billion Kuwaiti dinars, around 15 billion, short of $15 billion. This is a project that has been put on hold for almost 12 years, and it got implemented when oil prices went down. So I think the price of oil dictates the urgency of implementing such projects from not. And I don't think that that should be the driver. I think the government should push forward, implementing the economic reforms, making sure that the projects that are value-adding and job-creating for the future are implemented. Third element is investment in the infrastructure of the country. We are building 3 new major cities, one in Sabia, and now by the end of next year we will have a causeway. That causeway is about 36 kilometers in distance between Kuwait City and Sabia. This will shorten the distance between the two areas from 90 minutes to less than 35 minutes. That change is significant in terms of having appeal for that area, for establishing a new city in Sabia. Along with it comes all the necessary infrastructure and businesses that would come there. So things are looking positive. The biggest risk, in my opinion, is going to be the relationship between Parliament and government on priorities, and whether the government has the strength to actually push forward those reforms.
Thank you very much, Mazen. Our final panelist today is Dr. Simon Galpin, who's the Managing Director of the Bahrain Economic Development Board. That's a position he's held for the past 2 years. Simon's experience is very global. He's worked for Invest Hong Kong and also for Scottish Enterprise. This is something that Mazen already touched on, but I think, Simon, it's clear that in order to ensure a viable future whereby the GCC isn't overly reliant on oil, that the region needs foreign investment. What is Bahrain doing to attract it, and do you have any evidence that it's starting to work?
Well, Bahrain is a very small economy, and we have to try and turn that around and present that size as an advantage, so being perhaps a bit more nimble, being very responsive. And being a small economy for foreign investors means that they have greater access to decision makers, access to consumers, access to investors and partners as well. But the key access for us is always going to be access to the eastern province of Saudi Arabia. So whilst Bahrain is a population of only 1.4 million, you've got 5 million people just the other side of the causeway. And you have people commuting over that causeway to work for Saudi Aramco, but living in Bahrain. And every weekend, we have quite a few Saudis coming in the other direction to take advantage of some of the attractions that Bahrain has. Bahrain, of course, was the first GCC to drill for oil, and arguably will be the first to run out. So we began that diversification journey 15, 20 years ago. And now Bahrain's GDP, around 20% of GDP can be attributed to oil. 14, 15% will be financial services, 12% would be manufacturing. So we're making quite good progress in diversifying away in terms of GDP. Last year, non-oil growth for the first 3 quarters of last year was 4.8%. Overall GDP was 3.6%. So one of the fastest growing economies in the GCC. And there are 3 main areas that we want to focus on. We need basically foreign investors to get involved. The first is there's a very ambitious raft of physical infrastructure projects underway in Bahrain that will be completed within the next 3 to 5 years. These amount to around $32 billion worth of investment. So it's upgrading our oil refineries significantly, expanding our aluminium smelter to make it the biggest single-site smelter in the world, but also developing tourist attractions and physical infrastructure that will make Bahrain more attractive as a place to live and a place to do business. The second major opportunity, which is less tangible, is in the soft infrastructure. And it's making sure that we live up to our business-friendly Bahrain mantra, that we're adapting and adjusting our regulations to open up even more sectors to 100% foreign ownership, expanding and changing our bankruptcy law to allow particularly startups to fail and reinvent themselves. But more recently also to look at things like fintech. And our central bank, which is a very well-respected central bank in the region, has been very quick to move to put in place some interesting regulatory frameworks to allow fintech startups and scale-ups from around the world to come into Bahrain and to use our regulatory sandbox, perhaps to develop fintech products, to make them Sharia compliant, and then opening their products up to a much wider, larger Islamic consumer base, but also some of the big investors from the Islamic banks as well. So these things are happening quite fast. We need to make sure that we keep the momentum up, but there's every sign that, particularly on the digital space, we've got some good prospects ahead. A lot of people say that data is the new oil. Well, we've just had Amazon Web Services choose to locate their first major regional data center, not just in the Middle East, but the whole of Middle East and Africa in Bahrain. And that's really changing some of the goalposts for us and opening up new opportunities.
Thank you very much, Simon. So I think we probably have about 15 minutes or so for questions from the audience. And we just covered so much, and we didn't even talk about the Aramco IPO. So I'm sure there are a lot of questions. So if anyone has one, please raise your hand. Is there a microphone? Yeah, okay. Just there's a gentleman in the back. Thank you.
I was intrigued by the even distribution of people who expect higher or lower oil prices, and there is certainly a big uncertainty. But no matter which half is right, there is one interesting question. I would be interested in the views of the panelists. If the bulls are right and oil prices go up, then the question is to what extent the key countries of the Middle East will maintain the momentum for politically painful economic and social reforms, or whether they go back to complacency and enjoy the money. Whereas if the bears are right and oil prices decline by 25%, then the question is that if the countries burn their sovereign reserves that are really arming late, is there a risk that they run out of time? So I wonder what the panelists think about these two risks in the high or low oil price case.
If I may,
Sure.
I can give you an example about Kuwait, for example. When we saw the oil prices drop to below 40, there was pretty much panic and push for reform in terms of removal of subsidy, in terms of implementation of new taxes. And I can tell you that Parliament at the time was, despite the fact that they were not extremely in favor of it, but at least they can see the value of it because they saw that there are budget deficits that are coming up and they needed to take certain actions and steps to solve it. Guess what? Oil prices went back up. Everyone is, put it on reverse, as they said, and forgot all of the reforms. That's the reality. Unfortunately, if this continues, this is not a good recipe for a government or parliament for the sustainability of the country's economic reform. So those steps have to be taken now. If oil prices continue to go up, then so be it, great. We will have more resources to invest more into sustainable businesses that would create employment and value add for the economy. If not, we've diversified away from oil, and at least we have other sources of revenue that would cover any shortages that we would run into. But at least from my experience, the government and parliament tend to change their views as and when oil prices go up or down.
I think I would second that from a broader perspective. It fits very nicely because one can take the single case and broaden it. I mentioned that costs follow prices for companies and fiscal adjustment follow prices for countries. It's unfortunately also true the other way around. So the moment you have higher prices, and costs go up for companies and fiscal discipline goes down for countries. There's no doubt about that. But I think there's two important long-term trends which you should not forget. The world isn't static. This will not continue up and down forever, and it has already gradually changed. One of these long-term forces is that we will see a oil market which no longer rises in the sense that oil consumption will sort of peter out and then maybe not decline drastically, but the years of annual consumption growth in volume terms are probably limited, and that opens up an entirely new ballgame in which, as I said earlier, low-cost producers in a shrinking market are king, but they are king of a much smaller kingdom. Right? So that's an external force, and in my mind, there's very little doubt that we have a long-term situation of excess supply in oil markets, not excess demand. The other one is long-term forces from those countries themselves, because the situation is unsustainable in principle, no matter what the oil price is doing. When you have growth, and it's based, as we all know, to some extent on subsidies and so on. We all know that, we all agree. Electricity prices have to be adjusted, water prices have to be adjusted, fine. But there's more to it than that. This is a region where you need, when you have an apartment complex and there's an empty apartment, you need to cool it. Otherwise, there's mold in it. If you plant a tree somewhere, you need to water it. Otherwise, it dies. It has just simple characteristics which makes it sort of expensive to maintain, and which are crying out for other sources of revenue than just, because as the economy grows, if to some extent or only some parts of it produce negative value added, the costs of maintaining it, not the distribution and subsidies or not, will increase as well. And I don't see that going away, and I see little consideration, little way out, other than what you have mentioned, for example, use the natural advantages you have, data centers plus solar power, all these kind of things. That will have to happen regardless of what the oil price does. The unfortunate part of that story is that the a higher oil price always delays, these kind of adjustments, which are necessary anyway. One of the smartest things I've ever heard was when I used to live in Russia. It was one of Putin's key aides would always go around and said, low oil prices are good for reform. For a while, it has been echoed by some very prominent people on your programs in that region, but it seems to have gone away again. But that is actually probably has a big core of truth to it.
If I can just add, I think in the GCC also, we have to segment this discussion a little bit. I mean, it's no accident that the most aggressive diversification has happened in Dubai and Bahrain, where oil is the least important driver of the economy and ran out far quicker than elsewhere. I think if you look at the rest, frankly speaking, Abu Dhabi, Kuwait, Qatar have an enormous amount of latitude as to how responsive they are to changes in oil price because of the tiny size of the citizen population and the massive supply of either oil resources or sovereign wealth. The two really interesting ones are Oman and Saudi Arabia. Oman doesn't have those deep sovereign pockets. It doesn't have high-priced oil or gas contracts. It has to diversify much more urgently, whether oil price is 80 or 40. Saudi Arabia is a very different discussion. I would argue that what's going on in Saudi Arabia is, yes, a fiscal reduction to make sure that SAMA or Saudi Arabian Monetary Agency FX reserves are not just dwindled down remorselessly over the next 5 years, but also we have to understand diversification, austerity in the context of a political revolution that's happening in Saudi Arabia. If you look at where austerity has been focused, it's been focused at the elite level of Saudi society. And effectively, many of the recipients of the most lucrative patronage in Saudi are now being asked and forced to contribute to the funding of Saudi's diversification. The welfare, the benefits for the mass population, those have continued largely as before. But it's that elite level, circumstances for them have changed. Again, I don't see that changing whether oil is 80 or 40.
Any other questions? There's a question up here. Thank you.
So change completely.
Hello, I have two questions. One of the most discussed topics since the big issuances out of the GCC is the ramp up of debts. And when you look at the smaller economies, Bahrain and Oman, they've been really issuing aggressively. And my question is, what is your view in terms of if these countries are unable to meet their liabilities, will the other GCC countries step in? Is it non-negotiable in your view? And my other question is about the PEG. Is it here for the next year, 5 years, or forever? Thank you.
Very interesting question. In terms of the PEG, I think it's going to be extremely challenging. I think Kuwait differs from all the other GCC countries by having a basket, which is almost a PEG. If you look at the constituents of it, about 79 to 80% of it is dollar-based. That gives it some sort of flexibility in terms of changing the rates. Other GCC jurisdictions, particularly Bahrain and Oman, I think would be under significant stress if they are to maintain the current PEG, unless there are other reform agendas that would take place that would hopefully bridge the gap between the net foreign exchange exports, if you will. The first question, which is very important, will Bahrain or Oman be supported by other GCC countries? I think the question is, what we've seen in Bahrain has been a strong support from both Saudi Arabia, Kuwait, UAE, in terms of funding their infrastructure projects. I can tell you that we at Kuwait Finance House, we have more than $2 billion investments in Bahrain. And we continue to invest there, particularly in the infrastructure projects. Is it going to be sustainable moving forward? I think the points mentioned by my colleague earlier about transforming Bahrain into hopefully something that would be a regional hub for information and fintech could be something that would augment its current revenues. But in case something goes wrong, I think other GCC countries such as Kuwait, KSA, UAE would step in.
Did you want to quickly say something as well, Simon?
I mean, just answering the first question as well. I mean, first of all, from Bahrain's point of view, there is no plan B. Diversification away from oil and gas has to accelerate. It's not a question of putting the brakes on, but it's very, very important that we keep that momentum going. I heard the central bank governor speak just yesterday. The peg may be painful, but it's still the best option we have, at least for the time being. So no change there. And in terms of debt, well, the government, as you know, is cutting back on subsidies. There are scheduled reductions in the subsidies to electricity, to petroleum, and various other things. But it's also a matter of increasing taxation. And as you probably know, VAT is coming in right across the GCC, already introduced in Saudi and UAE, but Bahrain is committed to follow soon with a VAT too.
I think we have another question in the back. This may be the last opportunity for a question. Unfortunately, I think we need about 2 hours for this session. Sorry, go ahead.
Thank you very much for your comments. They're very interesting. One word which hasn't come up so far is China. And I'd like to hear from the panel, if possible, about the change of engagement with China as a customer for GCC states, and also the effects of geopolitical power in the region from China, and how you see that moving forwards and the change with the relationship with the United States and Europe.
Sorry, go ahead.
Let me just concentrate on the business perspective. When you have the kind of oil future and the perspective from Middle Eastern producer countries, it's very obvious that China matters, and matters a big deal. And when you have China's ambition, political ambitions translated to economics, one of the big things they want to do is to internationalize their currency, the renminbi. Very explicitly, the target of moving it into the SDR basket 2 years ago or so, and still high on the program. It is just that for reasons of their own internal reforms and the threats they were exposed to, they have not liberalized the capital account to the extent where this would really be credible. So there is a potential meeting of minds, So what has increasingly been discussed and also been in the newspapers, not some secret, is the question of whether you can bill oil deliveries in renminbi or in yuan. A week ago or so in Shanghai, there was an attempt to open, I think it was successful, it was opened, the first sort of future contract for crude oil, denominated in yuan, exchangeable into gold, convertible into gold, so to get it transferred in and out. Still very clumsy, probably not very, very attractive to a Texas shale producer shipping some high quality oil somewhere. But, for a long time delivery for a country which is an oil exporter and may have a trade deficit with China and can use this currency immediately to cover its own imports, and a potentially attractive position if you want to, proposition, if you want to engage in long-term contracts. And so on that kind of level, I think there's some commonality of interest, and they will remain intertwined. And the other big thing about how politics translates into economics in China would be the One Belt, the Silk Road. And there, it's a little bit less clear if we talk only about the GCC, how that would be affected. It certainly will have complications and an impact for some of the surrounding countries, but not necessarily for the GCC.
I think in terms of a broader frontier context, China is probably a much less important factor from an investment discussion with regards to the GCC compared to parts of South Asia, East Africa, Egypt, and even parts of West Africa. I think the currency one is a very, very relevant point, that the GCC could be an important pivot as to whether they're prepared to adopt Chinese currency as a form of exchange much more readily than others, and maybe even a form of FX reserves. But in terms of the geopolitical ramifications of investing or lending a lot of money for example, infrastructure and logistics build-out. That's a much more powerful theme in markets like Pakistan, Kenya, Egypt than it is across the GCC. The unknown question is over the next 5 to 10 years, as China begins to suck in more oil and petrochemical product from the GCC through the likes of Pakistan, will China's influence be more material when it comes to countries related to the GCC like Afghanistan and Iran? That's an open question. We haven't seen active change as a result of that, but that is something that we're going to see over the next few years.
At a grassroots level, we've seen the number of inquiries from Chinese companies grow by 40 to 50% in just the last 12 months, looking at Bahrain in the region. We need to be a bit smarter about presenting Bahrain as part of the One Belt, One Road initiative, because that opens up a lot of doors. But what's also exciting is the One Belt, One Road now seems to be moving away from just putting in place often physical infrastructure like ports and railroads and roads to cloud infrastructure. And again, that might fit very well with our digital transformation. And we're getting a lot of interest from Chinese investors in that space too.
I can tell you from Kuwait's perspective, we've seen a significant increase in Chinese contractors performing, government-based projects, or even sometimes contemplating some of the PPP projects that are underway. So we're seeing more involvement by the Chinese in Kuwait. ICBC opened a full branch in Kuwait, as a matter of fact. Reciprocity with China is Kuwait is building in collaboration with the Chinese government a $6 billion refinery in China. So as such, we're seeing a collaboration between the two countries on both sides, primarily investments from Kuwait into China, and Chinese performance in terms of projects in Kuwait. I still do believe that the US influence within the GCC is still very strong and predominant. And I do not see that, at least for the short term or potentially the medium term, any change in that formula. Looking down long term, I think China is going to have a significant weight and an important one in the Gulf, but I do not see it in the short or medium term.
Thank you very much. Unfortunately, we've run out of time. Thank you for the panelists and for the audience for your engaging questions. I think one subject we didn't really touch on was US interest rates and what the interest rate increases will mean for the region and for the broader frontier markets. And I think that's one topic that will be tackled by our next panel, The Big View, which is chaired by Justin Kerrigan. So I'd welcome the next panel to the stage. Thank you very much.
See you. See you soon. Well done. Thank you.
Thank you.
Thanks very much. So we're running a little bit behind schedule, ladies and gentlemen, just a touch behind schedule. So if you'd like to get yourself seated and settled, we can get the next session underway. Thank you very much. Well, my name is Justin Kerrigan. I'm the managing editor for emerging markets, which includes frontier markets here at Bloomberg News globally. And this panel is, or this session is entitled The Big View, and really it is exactly that. We want to take a very broad, sweepy look at the main risks and opportunities, strengths and weaknesses in the frontier markets class. Let's get the ball rolling. I think if we had this conversation a month ago, it might have been a little bit different. Just before what I call the wobble, the 2-week wobble that kicked off at the end of January. And I wanted to ask, perhaps I'll start, Julia, if I could, Julia Pellegrini from BlackRock. Do you think that has changed the landscape for frontier markets? Did it remind people of some of the risks, or is it, back to business as usual now?
Well, it undoubtedly has. What we've seen is essentially a market environment moving from the Goldilocks type setup that we had for the better part of the last 2 years, where you had growth starting to pick up and inflation picking up but rather mutely, to an environment where you have growth picking up but also inflation doing so. And the latest CPI print from the US has obviously reminded of that last week, or the Fed minutes yesterday. So you have inflation picking up significantly and an expectation of global rates rising. Now, the question is, are we going to be in a reflationary type of world where you have strong growth, inflation rising, and global interest rates moving gradually? In that case, you would have your frontier market spreads providing you quite a nice cushion, attracting investors' flow, and to some extent even tightening. Or are we moving instead towards a quantitative tightening type of world, for lack of a better name for it? One where we've seen, for example, the last 2 weeks, global rates actually increasing very rapidly, and even those frontier market spreads no longer providing you that cushion and selling off instead. So as I was saying, we've seen that over the past couple of weeks. We had a little taste of a potential quantitative tightening situation. We saw some wobbles. Now the question is, will we see capital flows to frontier markets stopping? I think to a good extent the sort of yield appeal of frontier markets will remain there. We have had the sell-off allowing at least a modest rebuild in premia across frontier markets, and as a result we've seen some investors coming back to the table. The last couple of days of more stable markets and new issues coming to market from a slew of frontier markets have shown that. You've seen some modest new issue premium coming through, something we were no longer used to over the past couple of years. So the yield appeal will remain there. I think in terms of flows to the asset class, we'll continue to see interest also from the fact that if you consider research into determinants of capital flows to emerging markets in general and frontier markets as well, the sort of EM-DM growth differential is still a key determinant, even when you control for the interest rate differential adjusted for the sort of QE experience of the past few years. This is something that the IIF has done a lot of work on, the Federal Reserve, but also JP Morgan has put out a recent paper on that. So that differential will continue to support flows into the asset class. And then I finally would say that there's an issue of structural under-allocation by many institutional investors out there. US pension funds come to mind, but so are many others that will continue to see some value in diversification in their portfolio, and hence some interest towards emerging markets and frontier markets more specifically.
Nathan Sheets, fixed income guy. Do you see that the same story in spread differentials?
So I think I would be probably a notch more optimistic about where we are in the global market setting. That I see the wobble that we had in January and more in February as being a healthy repricing of financial markets. And to be really precise, I don't think that there was a lot of questioning about the underlying macro fundamentals. It was more an issue of, given those fundamentals, how should they be priced? So I think the narrative of 2017 that we have a moderate paced and broad global expansion, that various components of global demand are strengthening, the global labor markets are improving. I think all of that's intact. And what we've seen over the last few weeks is the markets legitimately question whether they got ahead of themselves in terms of valuations, in terms of spreads, for example, as you highlight. And we're also starting to see a more normal response of wages and prices to diminishing slack. And again, the fact that we're seeing a little bit more, just a little more perkiness in the wage price complex than we saw before gives me more confidence as to where we are and more confidence as to where we're likely to be headed over the next few years. I don't think anything that we've seen would cause the Federal Reserve to say, oh, now we need to go more rapidly than we had previously announced. But it gives them more confidence in the path that they've announced for policy rates and their expectations for inflation. So I think that this creates a generally favorable environment for frontier markets and for fixed income investors in frontier markets. That's certainly our view, but it may also result in more differentiation of investment across these markets, which again is a healthy development.
Tim, I see you nodding probably more vigorously than the others about the repricing idea.
I agree with everything Nathan says. Yes.
Tim Adams from the IIF.
Well, I think it was a healthy experience. I think we need more of those. I think there was a sense of being priced to perfection, and life is rarely perfect. And bringing more volatility back in the market, I think, sensitizes investors to upside and downside risk. The global economy is the best it's been in over a decade. It's broad brush. If you look at the 185 countries in the IMF, most of them will grow faster this year than last year. The OECD countries, any way you slice it and dice it, the global economy looks better than it has in a long time. I worry about lots of things. We have what we refer to as the termites in the woodwork that may pop their little heads up over the next 3 to 5 years. But right now, it's pretty hard to argue against the trend.
Would anyone like to comment on the role of ETFs in what we saw? Was that a healthy thing? Does the effect of ETFs accentuate the panic when these episodes occur?
I feel called into question, given the institution.
Well, I'm thinking who's the most appropriate to address that one?
Well, undoubtedly, that sort of added momentum to market moves. What we saw quite interestingly was, especially for the hard currency component rather than the local currency component of the market, strong flows coming into ETFs in January, and whatever came in rapidly went out during the latter part of January and the beginning of February. So those strong flows did absolutely have an effect on sort of enhancing those market moves one way or the other. So ETFs have turned into large market players. They have allowed a number of investors that are not just EM dedicated investors, but more diversified crossover global investors to take exposure to EMs. And as a result, when market environments change, you can expect ETFs to play such role in terms of enhancing market moves one way or the other.
One of the elements in this discussion is politics and the whole concept of political uncertainty. And I think the term unprecedented political uncertainty was used. I want to kind of drill down into that concept a moment. Maybe Herbert Wigwe from Access Bank and Stuart Culverhouse from Exotix would like to have a go at that. Herbert, do you think we are in a period of unprecedented political uncertainty, or is that an overstatement?
I think it's an overstatement. If you look at the overall politics worldwide, things are getting more mature. If you look at emerging markets or frontier markets, as some people have chosen to refer to some other countries, you'll see that the political framework is getting to a higher stage of maturity than it was maybe 10 or 15 years prior. Nigeria is a strong case in point. Ivory Coast is. Ghana is, etc. We can keep naming other countries. If you also move to other countries like out the Dominican Republic, you will see stronger political environments, etc. Political uncertainty exists everywhere anyway. In the US, it also does exist. So I think there is just too much overstatement in talking about political uncertainty, particularly in the more recent past. Nigeria witnessed a change, and up until when the current administration came into place, there was too much talk about how politically uncertain it was. Our president took ill. There was just too much talk about it, forgetting the robust structure around him. And even if it is not that strong, it is making its way to a much greater level of stability and strength than you've ever seen before. Now, other things you see in the more developed markets also point to greater uncertainty, perhaps, all right, than you see in frontier markets. So, in my own estimation, I think there's just too much emphasis placed on it.
Yeah. Is one of the factors here, Stuart, what the political uncertainty, the political element in the developed markets? And we have to, of course, mention Donald Trump and protectionism and the whole question of trade agreements.
Well, exactly. I think if we were sitting here a year ago, we would still have a lot of uncertainty about what would happen to the world economy going forward. With hindsight, not much happened. Markets rallied, and that was good for EM, it was good for most assets. So in a way, that has been a little bit overplayed, but I think a year ago there was great concern about what would happen. More in DM than EM, I think, both in terms of Trump, but also the US-Russia pivot. I think there was a lot of uncertainty, but frontiers and EM more generally still performed well. I think in terms of political uncertainty at the country level, and going back to the point about differentiation, investors do need to differentiate across frontiers. They are not an homogenous block. Probably 127 countries in the world could be frontier or frontier-like, about 30 or so advanced, 30 or so emerging markets. So most of the world is a frontier, and that encompasses a broad range of institutions, political contexts, income per capita, etc. But if you look at what's happened just in the last couple of weeks, be it in Ethiopia or in Zambia or in Maldives, political risk is there, and you have to, I think, look at that, assess that, and do your due diligence, rather than this just blanket euphoria that we kind of saw at the end of last year, which is why frontier yields got, on our measure, one of the lowest ever at about 6%. We talk about this sell-off, frontier yields are still probably about 6.7%. So we're not talking loss of access to most of the world. We're talking higher yields, and maybe Nigeria and Kenya have recently paid the price for that market correction, but it's still very attractive over a longer time.
Well, we did some research here at Bloomberg in the last few days, and we found that actually frontier markets in the equity segment performed better or underperformed less, if you like, during the wobble than the developed and the emerging market segment.
Yeah, I think we tend to find that at Exotix. I've been doing this for 11, 12 years, and I think in market corrections like we've seen that tend to be more externally driven from the US or US treasuries, etc., it maybe takes 3 or 4 weeks for that to filter down into frontier markets, I think, because if you're a PM, and there are PMs here that know this better than I do, you sell your liquid bonds first. The frontier ones tend to be stickier. And if it persists a little bit more, then you might see a reaction in some of the more risky bonds.
Okay. Nathan, where would you say were which are the countries the stories where the risks are highest at the moment, and which ones are doing better in your view?
So, ironically, I think the political risks in the United States may be somewhat less acute than we had feared a year ago, but I still think they're present. And particularly with respect to trade policy, and there specifically with respect to U.S. trade policy vis-a-vis China. I think that the risks to NAFTA are reduced relative to a year ago, but the China issue is still very much front and center. And then I think there's a broader question for the United States of what is our role in the world? That the United States, for several generations, has been the leader in international economic diplomacy, and more broadly. And I think that this administration has questions about that. When I look into the emerging market and frontier world, I agree with the analysis that the risks are there, but that's one of the features, that's one of the defining characteristics of these asset classes. But Mexico's election is front and center. Brazil's election is front and center. There are ongoing question marks about the path to reform in Ukraine. So far, so good, but it's a tough slog. There are questions about whether Egypt can continue to pursue economic reforms. And then certainly, maybe the biggest question marks of all are about Venezuela and what the future looks like there. But I don't see these as being unusual. What's more unusual is the question marks about the center of the system, about what's going on in the United States.
People don't seem to talk, in my perception, as much about China as perhaps they should. You were whispering to me before this panel about it's not just the China story that could go wrong, but how China then impacts on other countries. Venezuela, of course, has strong links with China, and so we could unfold in that way. Tim, do you want to take a stab at that one?
Sure. Well, again, I agree with Nathan, and there's so many threads of what he just said, which I think are worth exploring. But he and I both, in our times in government, spent a tremendous amount of time and effort trying to establish a good dialogue between U.S. and Chinese authorities on solving common problems and addressing issues before they become problematic. Unfortunately, some of those dialogues are now in stasis. So I worry about the U.S. focus on China and China trade. I think the imbalances are going to get larger for a whole host of reasons. I think as we get closer to midterm elections, it will be advantageous for the president and others in the United States to focus on China as kind of the great villain with respect to global trade or regional security arrangements. And so there is the potential for what is fairly managed, mature relationship to have some hiccups along the way, and that certainly can have rippling effects globally.
Mm. Well, we did. Sorry.
So I mean, just on the China point, from a fixed income perspective, I mean, we talk about trade, sort of bilateral trade with frontiers and China, which is important, financial linkages and things like that. I think one issue where there's a big question mark in my head is China as a lender is much more prevalent within frontier markets now. Yeah. And it ranges from maybe relatively small, 10% of debt in Ghana, maybe, but possibly 50% in Ethiopia or Ecuador. So it's much more significant. Now, for China, it's probably a drop in the ocean, but for these countries, it's significant. What happens if there's a debt problem? And I don't think we have yet, in the international policy architecture, seen what happens if there's a generalized or a specific example or a more generalized example where China has to take a leading role within typical Paris Club type fora.
Exactly.
And this is one reason why I think Venezuela is such an important case study. But China is a key, maybe the key creditor to the Venezuelan government. And I think the way that they handle this episode will set precedents for them in a number of other episodes going forward. Now, what we've seen so far is that in places like Mongolia and Ukraine, they've been constructive in rolling over PBOC swap lines, and that's been a very important part of the financing picture. But the numbers are bigger in Venezuela, the exposures are bigger in Venezuela, and I think they're going to be more similar to the kinds of exposures that you'll see in other frontier markets. So this is a very powerful case study and really boils down to how does China want to see its role in the world more broadly?
And I would say we need greater transparency. There's a tremendous amount of flows going into frontier markets, emerging markets that we aren't aware of. It's not transparent. There's various channels. It's not only debt financing, but equity financing, which really is debt financing. And they're not a member of the Paris Club. My colleagues and I are constantly advocating or pushing the Chinese to become part of this multilateral process. And they're not at the table. And whenever there's a restructuring, we need to make sure the Chinese are there and a part of the conversation.
Yeah. In the previous administration, we pressed them, and it was close. Yeah. But I think that that's an initiative that is not getting traction at this stage. So hopefully, it will at some point in the future.
Well, it's interesting that the concept of transparency, because we were talking again before the panel started. About the whole idea of rising debt levels. Mm-hmm. And as debtors come to the market to raise capital, they have to kind of show a little bit more what's going on the ground. Julia, I think it was you actually that mentioned that point.
Yeah, no, absolutely. I think it's very important, and it's definitely risen in importance after we had some episodes of hidden debts, for example, on the African continent, the case in point of Venezuela, where we don't quite know exactly what's really going on. China becoming an increasingly important direct lender to some of these economies we're talking about. So all these issues we touched on, but also how, before we get to debt, how the fiscal pictures plays out. We place an enormous importance in our analysis on political issues, political transition situations, and how these impact institutions, not just at a very broad level, but really at the sort of bread and butter of fiscal issues, what goes on in the budget of a country. I was recently at the presentation of the Open Budget Index by International Budget Partnership that looks at transparency on fiscal matters across a large number of countries. They rank countries from 0 to 100, and unfortunately what they noticed in their last survey that is dated 2017, obviously was just presented, that compares results to 2015, is that in about 12 of the 27 African countries that they surveyed, they actually saw double-digit drops in their transparency index. Now, they caveat their results saying that they have made their requirements more stringent. So to some extent, the results are not directly comparable 2017 to 2015, but I think it's an interesting case in point that in some situations you've actually had some setbacks on transparency issues. What they also found, and I found it particularly intriguing as a bond investor, is that there's a nice correlation between higher transparency and a country having issued on the international capital market. So if you come to the market with a Eurobond, you're sort of pressed by investors that engage with you. They want to know where their own clients' money will end up, what you're going to do with this money. And of course, we're very far from perfect information, but to the extent that people like us can play a positive role in encouraging more transparency in fiscal practices in frontier markets, that should be actually heralded as positive, really.
Well, that's a great cue for you, Herbert, on transparency.
Critical. I think it's a very, very important point. And just as Julian said, you see significant differences between different countries and in terms of their levels of transparency. But by and large, I think the more transparent countries, if you like, will continue to attract more and more inflows in spite of the fact that you may start seeing significant, or well, not significant, increases in interest rates, particularly by the Fed. I think that looking at frontier markets in one entity as a homogeneous unit, just as you said earlier, cannot be right because they are all at different levels of maturity. And what you would find is that given their very nature, you will see some that will continue to pay decent interest rates just because of the size of the economies, the rates of growth, etc. And you will continue to see international investors, continue to migrate in that direction in search for yield, and the fact that there is still reasonable information asymmetry, in terms of how well people understand those markets and the premium that they're ready to pay for it.
Does anybody think here that the rise in interest rates and obviously the rebalancing, balancing balance sheets, central banks, is going to change the outlook for frontier markets as it trickles down? Maybe, Stuart, you could comment on that one.
It's a good question, and I guess the question I have to ask myself every day. And I don't know if I've got a good answer, but I think we all know that US yields, US interests are on the way up, US yields are going to go up. We don't know how far and when they will stop. Typically, these things tend to surprise you. And I think if you looked at the forecast by the end of this year for where US Treasuries would be at the end of the year, we're already halfway there, and we're only in February. I don't know if that's causing a reappraisal amongst forecasters or whether people think this is where we're going to stick. If we stick around these levels, then higher US yields, yes. I think probably EM fundamentals coming into this year are still strong, notwithstanding the wobble that we've seen. And therefore, maybe credit spreads can narrow, and that should still be a good outcome for EM sort of frontier borrowers. I think the issue will be for those countries with very large debt servicing needs, that if they had assumed the market would be there always, and it's not, what do you do? And that could impose painful adjustments on a number of countries. A couple would spring to mind. Argentina, that needs to borrow about 100 billion a year gross financing requirements, deficit and amortizations. I don't think the market has fully realized that, and they're borrowing all the time. If they can't, it's going to impose a much bigger macro correction on Macri than maybe he's undergone so far as we get closer to the next election cycle. So that's, I think, one to watch.
I think it's a year away now.
Pardon?
It's about a year from now.
Yeah, exactly. Ecuador's been borrowing a lot. We like Ecuador, but it has been borrowing a lot. One of the biggest issuers since 2013 in the frontier space, possibly bar Egypt. And if it can't borrow, then that's going to impose, I think, a political decision on Moreno of what he does next. I think for many of the African countries that want to borrow, then the debt service profile is still relatively light in the near term, because remember, a lot of these countries only really started borrowing in bulk in 2012, 2013. So they don't come due really until the next 3 or 4 years. But if you still wanted a funded deficit of 5-6% and thought you could do a Eurobond at 6%, you may not have so much borrowing flexibility.
So when, assuming worst case, so which would be the countries, or if you like, the asset classes that would benefit in that scenario? Do you think that other frontier markets would stand to gain, or would there be just a general kind of stampede for the exits? Maybe Nathan.
And the scenario specifically of rising rates in the developed world.
That's right. And the difficulties of servicing the debt.
So I think the encouraging global backdrop is an important cushioning factor as global interest rates move up. Another important cushioning factor is that when we look at a whole range of fixed income asset classes, our sense is that there's still more of return cushion in emerging markets, frontier markets, than there are in many other asset classes, and so that makes us relatively bullish on these countries as a whole relative to other assets. Now, as I said earlier, and I think consistent with what others have said, I do think that this will be an environment where there will be greater differentiation. And to the extent that countries have overborrowed or are not moving rapidly enough on reforms, I think that the markets might respond adversely in some specific country cases, but less so to the asset class as a whole. I think the asset class as a whole will continue to be seen as one that's relatively attractive.
I think, I mean, if you're looking for specific examples, somewhere like the Dominican Republic, which has got low debt, relatively good reserve coverage, strong growth, that I think would be more insulated from a period of a longer sort of sudden stop in capital flows. If you're looking at the other extreme, to me, countries like Ghana and Zambia are going to be very exposed.
So during this period of commodity price declines, let's characterize it in general terms, which do you think of the countries have done best? We touched on this in the last discussion. Which countries do you think have done best to kind of, grab the nettle and start to restructure the economies, diversify going forward? Maybe Julia?
Some countries have taken this as an opportunity to reform, but as the previous panel was touching, there's a real risk that this may come at least not to a stop, but maybe slow down. Now, we've seen, for example, interesting political transitions in Angola, an oil-dependent economy that has said time and again, and says this time again, that it would like to reform and diversify. Now, that's obviously a process that takes quite some time. There are some positive signs from the new administration. It is pertinent to ask yourself the question, if oil moves towards 70 and beyond rather than it stays where we're at, will the same incentive system be in place for these reforms to take place? We have seen some Central American, Caribbean countries instead taking more advantage of this Others, just like Angola and Ecuador, that again we're on the wait and see. We've seen some political transition, some talk of fiscal consolidation. Are they going to deliver? So I think we're really at a turning point, and it happens at a time where commodity prices by and large are still rising, and hence the concern is that that incentive will diminish. By and large, I would say that we have been encouraged by the responses we've had in interactions with policymakers across frontier markets in terms of their commitment to more reforms. We would like to see now this being delivered, but we understand it's a rather long-term process.
I was just going to add, another example would be Nigeria. There's been significant reforms. Still very early days, reforms on the fiscal side, reforms as far as diversification of the economy is concerned in agri and all of that. But just like you said, it takes a little while for it to become manifest, but I think the process is on.
And we've had the currency regime, of course.
Absolutely, yes.
Well, what's important to notice also in the case of Nigeria, and this goes back to what Stuart was mentioning about financing needs and moving towards an environment of faster rising global rates, is that Nigeria has the benefit of having worked really hard to create a deeper local domestic market. So in a sense, although it is now taking advantage of the international capital markets to issue, it can also rely on a pretty deep local institutional investor base that buys its own, the government's domestic bonds, right? So that's pretty important. Not all frontier markets can take advantage of this as a sort of fallback option. And that is, again, going back to the issue of transparency, and I promise I'll conclude here, something that takes time to develop. I was very fortunate to start my career actually as a Nigerian civil servant in the debt management office in Abuja, which has benefited over the past 15 years by an enormous amount of donor support to the DMO. So we're talking about World Bank, IMF technical assistance, but also the FID. And this has allowed this office to basically put together a pretty solid debt database so that it can track what's going on. It can put on its website when the next issue will come up. It can put up issue results and so on and so forth. And that has a very big impact in terms of attracting people like me now that needs to invest in their local bonds. So it goes back to transparency and reforms again.
Yeah, and on reforms, we were talking earlier, and I've been racking my brain now for the last 2 hours trying to think of reformers. And the best ones over the last 10 years in my mind would be countries like Georgia and Rwanda. Yeah. I'm actually struggling to think of a country in the last 3 or 4 years that has really reformed voluntarily. Most of the reforms that we're seeing now are because countries have had to, because otherwise they would run out of money, because they've gone to the IMF to get a bailout, and that imposes reform on them. But countries that just reformed, maybe Côte d'Ivoire over the last few years. I mean, Argentina kind of, yes, under Macri, so that's a new era in Argentina. But again, because they've got to raise $100 billion a year, they kind of have to as well. Just altruistically reformers, I'm struggling to think of many within the frontier space. And that's, not to disparage the asset class that I follow and love dearly, but just devil's advocate, I think that needs to be done. And to steal Madame Lagarde's phrase recently in the World Economic Outlook update, you have to mend the roof when it's summer. Mm-hmm. And I do worry about the point earlier, the question in the previous panel, that with maybe a little bit of an upturn in commodity prices and elsewhere, that policymakers will take their foot off the pedal.
Yeah. And the flip side of that is reforms are painful. Yeah. The long run benefits of them are tremendous, but along the way, it's not a lot of fun. So the natural response to the hole in the roof is not to want to tear the roof off and fix it, which is ultimately what needs to happen, but to try to patch it a little bit and make do. And it's only then when the situation gets more severe that countries take the necessary steps. And even Argentina that you mentioned, you could say was in such structural decline. And maybe it wasn't an imminent collapse, but it was in such structural decline that finally the voters said enough.
Right. Do you see that, just on Argentina, I'm intrigued, do you see this ending well? We're now seeing the kind of return of the whole trade union question and Macri increasingly under pressure, missing the inflation target again.
I hope so.
Yeah.
That I think this team under Macri is the best hope for Argentina for a generation. I think that they are skilled, they're knowledgeable, they're sophisticated, but the challenges they face are tremendous. Now, one thing that gives me hope is that Macri has been able to maintain political support. And if anything, he may be in a slightly better political position than he was 2 years ago. But now they've got to move on the fiscal. And I think if they don't, eventually that financing need is going to come back and be a real problem. This is their window of opportunity, I think.
But they got 40 years of really bad policy they've got to try to fix in a very short period of time. We've got a big event in Buenos Aires next month, and we've been cheerleading for the new government, but it's a daunting task ahead of them.
Yeah. I mean, it's a question of whether it can survive a political cycle. We're only halfway through the Macri era. We're all getting very excited.
If he gets re-elected.
But it's only 2 years. You know, politics in Argentina, it's full of surprises. So, I mean, let's get through 2019, and then transitions of continuity would be great. I would personally love to be around in 2117 to see if they repay the century bond. I don't expect I will be, but I would love to see that happen.
We'll come back here then. Yeah. So I'm very conscious that we're running a little bit short of time, so I'd just like to see a kind of, if anyone who has questions, just show their hand so I can get a sense of how many we might be fielding. Well, one so far.
Modest. Wow.
That's going to be easy.
That's modest.
Okay, 2 from Sonja. Okay, so that may just give us a little bit. Oh, we have 3. Okay,
it's like an auction.
All right, let's go for the questions then. There was a gentleman here, yes.
Very much for a very insightful session so far. I have a question for Mr. Albert. What would you explain the performance of the Nigerian Stock Exchange in January? According to Bloomberg, it performed, I think, one of the best in the world. Would you say it's due to the oil price or due to other factors? Thank you.
Well, I'll just say a couple of things. First of all, I think the markets are beginning to realize that there's greater transparency coming out of Nigeria. Secondly, I think it's clearer that if you look at the institutions that did well on the stock exchange, the fundamentals are a lot stronger than ever before. The third is the fact that you would find that frontier markets like where Nigeria is will continue to attract foreign investments insofar as your fundamentals remain strong, the returns are strong, all right, and investors actually do seek returns, if you like. And so that's what you've seen in terms of increased flows towards Nigerian stocks, towards the NSE, if you like. Yes.
Thank you. There was another question here in the middle. Somebody had their hand up. Oh.
Question primarily for Mr. Wigway. The local balance sheets have been, by the banks, have been pretty stretched in the recent crisis, and they've shortened those up by investing in mostly local government bills and bonds. But now Nigeria was switching their debt issuance and sovereign debt mix more to local currency, more to foreign currency borrowing. Is that going to force the local banks to do more credit extension to local businesses, and that going to be a stimulative effect to the economy going forward?
Well, the local banks are already switching towards supporting the real sector, if you like, in Nigeria. There's a greater push towards agric. There's a greater push towards also the power sector, because the government is basically doing a couple of things to strengthen that sector, which, as far as I'm concerned, if it is resolved, all right, can actually lead to double-digit growth as far as GDP is concerned, all right. There are also issues with respect to logistics, all right. Logistics, and I'm now talking about the entire value chain in agric, right from production and taking the products, the primary products, to the sites where they ought to be processed. So there are several things that the local banks are doing. There's also a greater focus towards the SMEs, all right, which, as far as I'm concerned, also represents the bane for growth of those economies. So you are beginning to see it happen, and that was what I was alluding to when I was talking about the reforms and all of that is happening in Nigeria. So that's what you'll find. Banks had become a bit lazy given all the issues and the recession, and felt that the easiest way to protect themselves was to basically invest in government securities. With the crash in those yields, all right, they are beginning to have to look for where else can they invest in. taking risk into consideration, all right, and things that can actually, all right, lead to long-term growth as far as the economy is concerned.
Anyone not got a question for Herbert? Srini, complete disclosure, Srini is an editor on the emerging markets team at Bloomberg News.
Thank you. Morning. Thanks for the delightful views. My question was about the elephant in the room, Donald John Trump. He's pretty much symptomatic of the political risks emanating from the developed world that could potentially affect emerging market and frontier market investments in terms of immigration, in terms of trade protectionism, in terms of all the things that we have seen in the developed world. So how do investors position in emerging markets and in frontier markets, fully aware that some of the risks may not come from those local markets, but from the developed markets? Thank you.
Who wants to go with that one first? You're nodding there, Nathan.
I think it's a very interesting question. I don't know whether there's any specific hedge or any specific investment strategy that can protect the global economy in the event of trade disruption, say, between the United States and China. I very much hope that that doesn't happen, but if it did, I'm not sure that there's any specific investment response to that I can think of. One might say that in that environment, maybe emerging Asia would be a little bit more affected than, say, Central and Eastern Europe. Maybe some of the commodity exporters that would feel some echo from a slowing in China's economy might be more affected. But I think it would just be a global shock, and the tide would rise and fall for all of us, DM, EM, and FM, more or less together.
You're not burying gold bars in your backyard.
No.
But you would agree, not to interrupt, but you would agree that this polarization, this isolation, this sense of lack of trust in government we see in the U.S. is a continuous process. This is not a unique, discrete event of Donald Trump. This is a long-term process. It's unlikely to right itself anytime soon.
Time for just one question. I think, Sonja, you wanted to ask something.
I really had a question, probably more directed.
Sorry, wait, the microphone's just arriving.
Probably this is one for Julia and Stuart, but others may like to comment. So we're well post-crisis now, and there's been a lot of interest, investor interest in frontier markets. Are you seeing better market liquidity conditions, or is it still relatively illiquid and hard to transact?
Well, you go first.
Okay. I would say still a mixed bag. We've seen some improvements in liquidity, not least because some of these countries have been more regular participants on the global scene, on the global capital market scene, if you like. So by definition, they have created more liquidity for people like us, bond investors. By and large, though, we're still far off, the more emerging side of the spectrum. So there's bigger brothers and sisters. To that extent, I think we're still some way to go. And it is true that also over the last couple of years rather in the period sort of 14, 15 into 16, there was a pause in issuance by frontier markets. So we have taken a break. So we have taken another dip in that process of building yield curves and liquidity, precisely because of the drop in commodity prices. Some countries not really approaching capital markets with quite the same glamorous story they could have had right before or right after the commodity price shock.
I think liquidity is there until it isn't. And I don't mean that in a facetious sense, but even for liquid Brazil, if there's a shock, it's very difficult to trade a Brazilian bond.
ETFs aren't going to solve the problem.
ETFs make it harder. I mean, actually, they create interesting buying opportunities for the dedicated guys, but that benchmarks and ETFs, I think, sort of contaminate that sell-off and add to the momentum, but then maybe there are nice entry points to get into. But maybe I've got some fixed income colleagues of mine at Exotix in the audience, and you can ask them after this over a coffee. the typical sub-Saharan African bond bid offer is what, 20 basis points or something like that? Nodding at the background, maybe. Maybe a few years ago it was 1 point. The liquidity is tightening for sure, but you don't know if it's going to be there tomorrow.
Yeah. I promised only one more, but Christoph, I see you waiting there with the microphone.
Out of sight. I found Nathan's picture very intriguing about Venezuela being a test case for China's potential commitment to, shall we say, exotic clients around the world, frontier clients. Would you want to venture a guess of how this will turn out, or if not that for any one of you, basically, if not that much, then at least a guess how this connects to the Trump complex? So the more hostile the Americans, the more likely China and Russia, for that matter, of course, to support places like Venezuela. Is it that simple?
My guess is that China will ultimately play a constructive role in helping address Venezuela's debt problems. That I think that they see their actions in those kinds of cases as an extension of their broader geopolitical standing. And so I think it's consistent with those objectives for them to be at the table and participate in a constructive way in a restructuring. So that would be my expectation. Obviously, a lot of uncertainty around that. I'm not going to guess as to how some of those other countries might respond.
Okay. I'm afraid we're going to have to end it there. Thank you very much for a great discussion. Thank you for your questions. And I would say it's great to see so many people here. And thanks again. A round of applause for our panelists. Thank you, sir. We're going to have a quick coffee break here. I'm not quite sure. We've got 15, 20 minutes? 20 minutes. Hello. How are you? I look, yes.
Close your eyes. I just want to get a little close to you. Just want to get a little close to you.
Okay, so I'll ask them to sit down, right?
Yeah.
Okay, like to take your seats?
Yes.
Up there. So,
arrangement?
yeah, why don't... I think Laszlo, if you go on the last one, there. Sorry, Stuart, Laszlo goes on the last one.
Sorry?
Swap places. If you just move up that one, yeah.
Musical chairs. How are you doing, Stuart?
Where's Rahul? Oh, Rahul. Hey, Rahul, how are you doing?
Good to meet you.
Have a seat. Yeah, if you sit there. And Rahul here. Yeah. Okay, if everyone can take their seats, that will be great, and we can get started again. Okay.
Oh, okay.
Okay, well, my name's Gavin Sirkin. We've had, I'm sure you'll agree, a really fascinating morning of discussion so far, from the World Bank's view on how to de-risk some of our frontier markets, to the spotlight on the Middle East, to the big macro questions that we just heard around rising rates, geopolitical risk. We're now moving on to the more micro view from our panelists here, and I'd argue it's, in fact, perhaps the most interesting aspect of frontier markets. And I'm not just saying that really honestly because I happen to be moderating this panel, but because if you think about frontier markets, it's all about idiosyncratic risk. You know, these are countries that don't behave according to how they should be correlated with world events very often, and that's clearly part of their appeal. But what really struck me when I visited 10 frontier markets for my book, Frontier, which was with Bloomberg. And what really struck me from those 10 countries was while governments and central banks and, frankly, bad diplomacy can wreck an economy overnight, it's really it's the extraordinary individuals and their companies that really create the big opportunities in frontier markets. And we titled this session, Big Data, Big Opportunity. We'll be looking for what really the opportunities are from big data, but also from everything else besides. We're focusing on the innovations, the ideas that are changing the face of frontier markets in terms of both the markets themselves, how to make money, but also the societies that are within those countries. We have a very suitably qualified panel to take us through that discussion, starting with Rahul Desai, who is responsible for managing Fidelity Institutional Asset Management's emerging markets all-cap strategy. Previously worked on the EM team at Fidelity Management and Research, covering EMEA and Latin America, consumer and industrial sectors. Rahul's truly global perspective, though, comes also before joining Fidelity when he was a senior associate focusing on Asia and Africa for the Boston Consulting Group. It's also my pleasure to welcome Sonja Gibbs, who we've been working very closely in organizing today's event. Sonja focuses her research on global trade, capital flow, systemic risk in financial markets and banking sector analysis, emerging and frontier markets, so pretty much everything we've been talking about this morning. Rahul and Sonja, as perhaps the panelists with the widest remit in terms of your investment and your research, I want to start with Rahul, what you see really as the big opportunity within frontier markets.
Sure. So I mean, as you explained, I run an emerging markets fund, and so my mandate is to invest all over the world within emerging market countries. But frontier is very much part of my mandate as well, and so I do have a number of investments. And what I typically look for, especially when I'm looking at frontier markets, is countries that fit into a couple of broad areas, and those I find really interesting. So the first one would be, a country that's going through a true economic or political transformation. And as an example, in the past, something we would be familiar with, a pivotal moment for India was economic liberalization in 1991, and that changed the sort of trajectory of India from a very socialist flavor to a very free markets flavor that we have today. And really, the bull market in India has its roots in that 1991 reform. And so that kind of structural pivotal change is of interest. And today I see that in Argentina. And I was in Argentina quite recently, meeting with the capital markets regulators there, meeting with a number of companies there. And it definitely feels that with Macri's election, that you've turned the corner of 40-odd years of Peronism, and there was a vicious cycle that the country was stuck in. And so in terms of the micro opportunities there, there's just not been a lot of investments made in Argentina on the ground because of the absence of capital. And so I have an investment there in a cement company because there has been no investments in terms of cement capacity for the last more than a decade under the Kirchners. And now that, the reforms have happened, they're able to tap into the capital markets again. Investments are coming back in. The country's expanding again. Cement consumption is expected to go up.
And cement is like an accelerated bet on economic growth.
On economic growth and infrastructure recovery and so forth. And just basically, the country's been so starved of investments for such a long time. Cement would be one area where you'd see that come through. So that I think Argentina, obviously it's early days, India in 1991, if you think back, it was shaky for 5 or 6 years after that, but then, the roots were sort of set then. And I see a lot of similarities in that sense in terms of a pivotal moment in Argentina. Time will tell, but I think it is an interesting space. Okay. And then the second thing I would say is, so aside from the pivotal things, emerging markets, the ones that truly emerge are the real export stories. So Singapore, South Korea, Taiwan, now China. The thing that helped them transform was an export story. And so I look for those kind of countries within Frontier as well. And so, the ones that stand out to me are countries like Vietnam, South Asia, parts of East Africa are quite interesting as well, where there is a true export story to be said. And so again, going back to micro, I have an investment now. It's a Chinese listed company, but they have so what's happening is these guys manufacture lingerie for Victoria's Secrets, for example, among other companies. They're relocating factories from China now to Vietnam and Sri Lanka at the insistence of their clients, because labor costs are much lower in Vietnam. Trade policies are going to be are likely to be more favorable, with Sri Lanka or Vietnam. So you're seeing that sort of next leg of export-led growth in these kind of economies, and that's something I'm tapping into as well.
Okay, so the big opportunity from Rahul is Argentine cement and Victoria's Secret producers in Vietnam. Sonja.
Absolutely.
So I'd take a step back here and look at in the larger picture. You see this perception of opportunity on the part of foreign capital coming into frontier markets. And the strength of these capital flows is really a good indicator that investors do perceive these opportunities. We see about $150 billion US coming into frontier markets this year, up from $90 billion in 2015. And relative to the size of their economies, frontier markets are actually taking in more now, capital-wise, than emerging markets. So something like 7% of frontier market GDP is coming in foreign capital flows. And that's about twice as much as goes into emerging markets. And of course, some of these are chasing yield, the hunt for yield, or capitalizing on the growth differential. But a lot, as Rahul mentioned, is targeting longer-term opportunities that are the direct result of transformational technology. And so one way to look at that is the strength of foreign direct investment, or FDI. While equity FDI for the larger emerging markets is in fact slowing down, it's been very resilient for frontier markets, and in fact is up by almost 50% since 2015 to something like $60 billion US in foreign direct investment this year. So suggesting a shift in emphasis to new opportunities. And then, there are so many ways in which partnerships between large global financial institutions and firms in frontier markets are taking shape, all different kinds of ways, which I think we'll get to discuss, but mobile technology, mobile payments, credit scoring. I think there's a fascinating firm in Pakistan
which uses, it's called Credit Fix, and it's created a credit scoring model for customers that don't have enough of a profile to be measured on traditional metrics. And so this kind of innovation around credit ratings is helping both individuals and small businesses. So all kinds of things going on. Another interesting development is in Ghana, where Stanbic is partnering with Dream Oval, a software developer, and they make an app called Slide Pay, and it's a disruptive mobile service that enables seamless money transfer and merchant to person and person to person payments, also government payments to people being done by mobile technology. All of these things, inclusive insurance as well. I mean, that's another whole area. There's a company called Macroeconomic, which provides insurance solutions in frontier markets, including Vietnam and Kenya. Apparently, in Kenya, you can get a health insurance claim turned around in something like 7 hours.
Well,
I'll have some of that. You know, that works for me.
Yeah.
So really tremendous opportunities.
Okay, well, I want to hold that thought on inclusive insurance because it fits nicely with Stuart Langdon, who leads investment in South Asia for Leapfrog Investments, which is an impact investor that's also the largest dedicated equity investor in financial services and healthcare, focused on emerging consumers, most of them living and working in Africa and South Asia. Leapfrog was listed last year by Fortune magazine among the top 5 companies changing the world for the better, alongside big names that we'd know like Apple and Novartis. Much of the focus of Leapfrog, as the name suggests, is about leapfrogging infrastructure, leapfrogging technology. And you know, we all know the examples of that, which Sonja's touched on mobile phones to mobile money, fixed transfers, banks outmoded by mobile money. Stuart, maybe illustrate with some examples how you see this trend of leapfrogging in terms of infrastructure and technology driving the aspect that Sonja touched on, which is financial inclusion, insurance inclusion, health inclusion.
Sure. So I think the first thing to say is that financial inclusion is still a huge problem in certainly the markets we operate in, or the frontier markets, and actually for the global economy in general. I mean, if I look at the areas where Leapfrog invests, which is sub-Saharan Africa, India, and Southeast Asia, these are still markets where 2/3 of the population don't have a bank account, virtually nobody has insurance or access to formal savings programs, and that causes huge problems. It causes huge problems for the individuals concerned, because it's very hard to lift yourself out of poverty if you can't borrow from a responsible, regulated lender. It's very hard to protect yourself if you can't buy insurance, and it's very hard to build your wealth if you can't save reliably. And for us, as global citizens, it's a huge problem because it means that far too many people in the world still live in poverty, where the technology and the business models certainly exist to start to provide them with the essential services that could lift them out of that. So when we talk about wanting to be more inclusive as capitalists, if we talk about the global economy working for more people, this is really something that we need to focus on. And I think there are 2 or 3 areas that we are focused on in terms of our investment plans. I think firstly, for us, mobile has always been incredibly important as a theme. I think people tend to underestimate the importance of mobile in frontier markets because it's such a familiar story that everyone in Africa, everyone in Asia now has a mobile phone. But when you look at it, you have this landscape where there's very little traditional infrastructure, and you have these completely dominant mobile operators who are by far the biggest companies in their markets. They have by far the best known brands. They have more data on customers than anybody else. And critically, they can aggregate more customers than anybody else. So we very often come across businesses now who are operating in Africa, and we say, which country in Africa you want to focus on? Is it going to be Nigeria because that's the biggest economy, or South Africa because it's the second biggest economy? And they say, no, we want to partner with MTN because that's far more people than any one country in Africa. And we've worked with a number of businesses now that we've invested in that use the mobile channel. Bima is the best known of those. That's a similar business to Macroeconomic. It partners with mobile operators to sell insurance to their customer bases. And in the 5 years that we owned the business, it went from virtually nothing to having 30 million customers across 14 markets, because the because of the importance of that mobile channel. The second thing would be this theme of credit scoring, which we were talking about earlier on. What we're seeing there, the big problem in emerging market financial services is, how do you price risk for a group of customers who don't have formal credit histories, don't even have bank accounts? And increasingly, we're investing a lot in businesses that are using people's mobile data or their payments data, or maybe in some cases their social media data, to create proxy credit scores. And what we're finding is that in Asia and Africa, people are able to bring down their credit losses by something like 60% by using that kind of technology. And all you have to do is, customers come in, they give the lender their mobile phone, and all of this can be done instantly. You can instantly price the risk really accurately. So think how disruptive that is in a market where for decades it's taken months and months and loads of paperwork to try and get a loan. And then the third thing for us is really on the payment side. I think people still underestimate the challenges for all businesses in these markets of simply, if you're a lender collecting interest in cash from villages in Kenya or India, it's a huge cost. It's a huge amount of bureaucracy, and it's a real pain for the customer. And the fact that all of that can be automated out of people's mobile wallets, or in some cases out of their airtime balances, that's another area where we really see a lot of growth and productivity.
Okay, well, there's a tangential link with our next panelist on the topic of social inclusion, because Sandip Sada is the CEO of Quiptel, which is a company that was recently snapped up by London Stock Exchange listed Falcon Media House. Quiptel and Falcon are focused on bringing live video streaming across frontier markets such as Mongolia, Nepal, parts of Africa, as well as what we were having the discussion earlier might be classified as frontier, which is places like rural India. Crucially, by using an open internet system, so-called OTT, over the top, which replaces the expensive need for satellite, for cables. Sandip, just tell us about the vision here. What is it that for you the opportunity represents? And I'm thinking both in terms of the investment opportunity, but also in terms of inclusion and all kinds of aspects of that.
Yeah, thanks. And I think Stuart touched on the kind of the coverage on mobility. So for us, rather than frontier, it's about the demographic. So we're looking at pretty much the growth of mobile across Africa and the Southeast Asian markets. And just like how we transform the money transfer business, we're seeing the largest consumption is video. And that video is consumed from every aspect of entertainment, information, education. So therefore, our focus is how do you actually deliver that video experience and services into these markets at a much lower cost, and therefore also disrupt the infrastructure that currently exists there, and enabling them to leapfrog from where they are today, and not really having to, I suppose, use our existing business models. And in some ways, they are more disruptive than what we're doing out here. And some of an example I think you touched on briefly is Mongolia, where the aim there was how do you reach, the project we did there with Mobicom was how do you reach into the summer homes, the yurts they have. There is no cable infrastructure. You don't need to be porting your set-top boxes, but everyone's got mobile. And therefore, being able to receive what you're watching at home on the go, as well as then they actually created a whole ecosystem around this, which is about what they call candy points, which were effectively their own currency, which they then used to transact in the shops to buy whatever products you wanted. So we are seeing this whole, effectively an ecosystem value chain being created around what I would classify as a creatives industry in these markets. And similarly, we're doing this in Tanzania, Namibia, where once you actually streamline the cost of delivery of the video, you then have the local production businesses that are able to actually take their own content and reach the audiences. And so therefore, you get this whole circle of investment coming in from the content side all the way into the distribution and consumption. And each data point actually enables you to create this value that you in these regions.
Okay. And finally, we have Laszlo Varro, who's chief economist of the International Energy Agency, which, as many people will know, is an autonomous organization looking to ensure we have reliable, affordable, cleaner energy in the 29 IEA countries and beyond those. Laszlo, we've been hearing all about the importance of mobile phones driving live video streaming, driving health services, education, insurance. But of course, you can't have mobiles without one key element, which is electricity. So from your perspective, how are we doing in terms of getting things moving, addressing the gaps that we have in whole swathes of Africa where electricity has been an issue? What's the opportunity here, and how do you address the gaps?
So some of the most striking images of global inequality are satellite pictures of planet Earth at night, where Africa is dark. Okay, and in Africa right now, 90 million kids go to school, where the school itself doesn't have electricity. And there are 350 million women spend on average 1.5 hours a day collecting firewood from the bush. So the impact of this darkness on human capital and productivity is staggering. And we are working with the United Nations. The IEA is acting as the tracking agent, tracking the progress towards sustainable energy supply. And I have to say that the question of to what extent you can leapfrog a conventional energy system is a bit confusing debate. There are 3 levels of leapfrogging. One, when you leapfrog conventional power generation, you build a large wind farm, you build a large solar plant, you build a geothermal power plant, and use that electricity and feed that into a centralized grid, but you don't use oil, gas, and coal. That's one level of leapfrogging. The second level of leapfrogging, when you leapfrog the high voltage long distance transmission grid. So you build a microgrid in a village, you link 100 houses with a small solar plant or a small hydro plant, there are a couple of small businesses, but you don't link that village into a national long distance high voltage transmission system. And then there's the third level of leapfrogging, where you even bypass the distribution grid and you give solar panels and batteries every home, every house. Now, there is a bit of a faith-based debate between these 3 alternatives. So there are very strong emotions. Now, instead of that, we relied on big data, and we built a geospatial analysis of the continent of Africa with a 1 kilometer times 1 kilometer granularity, collecting the data kilometer by kilometer on population density, weather patterns, climatic conditions, urbanization patterns, and estimating the optimal energy access pattern with a very fine granularity across the continent. Unsurprisingly, the answer is that it depends. I mean, Africa is a huge and geographically diverse place. You should be very, very suspicious when anybody starts to talk about a one-size-fits-all solution for Africa. Electrifying the city of Lagos with 20 million people and abundant natural gas next door is a completely different challenge than electrifying rural villages in South Sudan. So when you looked at the current activity, which is basically the actual policies that are implemented in the various governments, there's roughly $6 billion investment into expanding electricity access in Africa, which is, by the way, peanuts in the context of global energy investment. That's much less than what the oil and gas industry spends in investing export-oriented projects, exporting oil and gas out from Africa. Now, this $6 billion buys you electricity access for around 14 million people every year, which is by and large the population growth in Africa. Okay, so with a bit of a simplification, whatever we are doing today is sufficient to stop the problem growing and stabilizes the number of people without electricity at roughly 600 million. But we are not solving the problem right now. Now, with the current level of investment, within this inadequate investment, there is a limited degree of leapfrogging. With a bit of a simplification, with the current electrification investment is 3 roughly equal components. 1/3 is off-grid solutions, village microgrids and off-grid solar solutions. 1/3 is centralized renewables, Africa is abundant in hydropower. So there's, for example, in Ethiopia, which is one of the success stories of energy access, there's a very uneven progress. So around half of the progress in the continent is Ethiopia and Kenya. In Ethiopia, this is largely reliant on big hydropower plants feeding a centralized grid. There's nothing wrong with that. There's a brilliant hydropower potential in Ethiopia. In Kenya, it is much more of a combination of technological and financial innovation. Microfinanced solar projects are flourishing in Kenya. Another 1/3 is good old school conventional generation. Africa is abundant in natural gas. In fact, the amount of gas which is flared in African oil fields, where it's coming up together with the oil and the companies don't do anything with it, that amount of gas would be sufficient for 100 million people. Yeah. So, and even under a strong climate policy, I believe it's 100% legitimate for African governments to want to use their own natural gas to provide development. Now, when we looked at what the governments say they want to do as opposed to what they actually doing in real life, we call it the energy for all scenario, which is consistent with the United Nations Sustainable Development Goals. Now, the first observation that we had that to reach those Sustainable Development Goals, the electrification investment needs to scale up by a factor of 4 to around $25 billion a year from $6 billion a year. Now, you finance professionals know that there is $25 billion available for investments if the business models are appropriate. But very importantly, in order to reach the Sustainable Development Goals, you don't scale up the current investment proportionally. Because even under the current policies, many African governments are reasonably well on track to electrify the big cities. So increasingly, the energy poverty problem is concentrating in villages in remote regions. And as you move away from the grid cities, the competitiveness of the off-grid solutions is increasing. Mm-hmm. So when I looked at the additional investment, which is missing in order to electrify Africa, 70% of that is off-grid solar solutions. You still need to increase investment in a conventional centralized system as well. Okay, you cannot have a city of 10 million based on rooftop solar only. But 70% of the additional investment which is currently missing would have to go to off-grid decentralized solar solutions, either microgrids in cases where you have decent-sized villages, or in off-grid solar solutions. And this is the point where we feel that financial innovation is at least as important as technological innovation.
Okay, I'm interested in picking up on that point, the innovation that you see in frontier markets on some of the technology like, off-grid solar technology. Stuart and Sonja, you touched on the technology of measuring people's credit risk, financial profiling. Sandeep, I know that some of the Quiptel work has been in just eliminating buffering from live video streaming, which we lack here in the developed world. So I just wonder what the potential is for the innovation that is created in frontier to overtake Silicon Valley in some aspects. Who wants to take that question first? Sonja, maybe?
I think that the scale is such that that's a difficult comparison to make. However, some of the transformation is truly amazing. I was also looking at a question of remittances, right? Because so many citizens of frontier markets are working abroad. And there are companies working on biometric techniques that enable remittances to be much safer and speedier. Yeah. So, I mean, maybe not rivaling Silicon Valley, but certainly making tremendous strides.
Stuart?
Well, I think what we see is that across Asia and Africa, whereas in the West, different digital businesses have developed their models based on competing with very established traditional infrastructure and very established ways of doing things. In many of these markets that we operate in, the energy sector, the healthcare sector, there's virtually nothing there. So businesses tend to completely reimagine business models based on a blank sheet of paper rather than a very established sector. And I think that's a huge advantage in terms of driving genuinely fresh thinking. I'll give you an example. We're invested in a couple of businesses that have started to offer telemedicine, so phoning up doctors basically in different ways. The first one was a health insurance business that struggled because of the lack of formal healthcare treatment systems. So they set up their own telemedicine offering. The other one was a pharmacy that struggled with the same thing. People couldn't get to GPs, so nobody had prescriptions, so it was difficult to grow the pharmacy. So they started their own system, slightly different, where they got people to come into the pharmacy and then they'd have video calls with doctors. It's hard to do that over the phone with people's regular mobile accounts because it uses up too much of their data allowance, which is very expensive in the frontier markets. But by bringing people into the pharmacy and allowing them to see doctors over the video, they could get treatment, they could get a prescription, and then they get it in the pharmacy. Now, I would go around last year and tell our investors around about this in the US and the UK. And they would all say, wow, this is fantastic. I mean, how can we get this? This sounds fabulous, because they're all fancy fund managers, and they all think if they take an hour off work to go to the doctor, then the capital markets are going to collapse in some terrible way. And I think we'll see more and more of that kind of thing, where the need to invent that kind of infrastructure in Asia and Africa will lead to totally fresh thinking about business models that actually sounds appealing to people in the West.
Sandra.
Yes, now, on the energy field, on the supply side, most of the innovation is done either in the West or in China. So Africa hugely benefits from cheap solar, but that cheap solar is primarily due to the Chinese solar industry. But where I would say where innovation in developing countries plays a very, very important role is the demand side. Okay, so you buy a new refrigerator, you plug it in, that's roughly a 50-watt capacity need on the electricity network. Now, most of you wouldn't know this 50 watt by heart, because you have several kilowatts of electric capacity available in your house, so you couldn't care less whether it is 50 or 60 watts. Now, when you have a 10 kilowatt solar module for an entire village, whether that refrigerator is 50 watt or 25 hugely matters. So there's a very interesting innovation going on in ultra-efficient electric appliances, which can provide comparable services with a much lower electricity consumption. I would highlight one big success story that you see from the satellite pictures is that 15 years ago, India was also dark on the satellite pictures. It's not dark anymore. India is now light on the satellite pictures. Now, the Indian government did a lot of hard work on the supply side, but what they also have done is that they had a very well-organized program rolling out 400 million ultra-efficient LED lights all across India. Now, you add them together, compared to conventional light bulbs, that's the equivalent of 20 million additional solar panels that India would have had to deploy. Now, the Indian solar program is doing well, but I don't believe they would have been able to add 20 billion more. So the ability to provide the same services with a lower level of electricity consumption was absolutely critical. These are products for which there's no real market for this type of appliances in either in the West or in China, in countries which have robust high-capacity electricity networks, because here we don't care about the refrigerator. But in Africa and India, it hugely matters.
Sandra.
Yeah, and similarly, the whole ethos around building what we did was in the frontier markets, as you say, where it's a hostile environment, it's congested network, you don't have satellite, you don't have a lot of fiber and broadband, it's all around mobile. So being able to deliver a TV-like experience in those markets without any buffering, which, I was in the US last week, they were still showing me sitting in New York and saying, look, this is buffering, I can't see the video, how are you guys doing in that market? So we're actually bringing that back into the, if you're calling it developed markets, whatever you want to call them, back that technology, having tried and tested it out there, which is, again, the uses are there for that kind of technology coming back into these markets.
How much, Stuart, you touched on this, and I'd be interested, particularly from Sandip and Stuart's point of view. You talked about data costs being prohibitively high in many cases in frontier markets. How much of that is a block to the types of investments that you are focused on? And do you see data costs coming down? Because they are, very often much more expensive than they are in the developed world.
True, but we're also seeing the operator, I'll give you an example, Jio in India, pretty much put a no cap. You could use as much data as you want, right? So that just happened a few months back, and that's disrupting the whole flow of video consumption. So if therefore it's all about what are the operators going to offer to sustain these customers and to keep them, and therefore delivering value-added services. We're seeing a lot of e-education type program that we've done in Namibia, where people are using that model for schools and parents are paying for that. So there is a right balance depending if you can optimize both the data consumption and the delivery, then those models can again be transferred out here.
Okay, Stuart.
Well, I would agree with that completely. But I think the other aspect of it, which is interesting, is not just the cost of data, it's what's going to happen on the smartphone side over the next 5 years. So if you look at it, I think there's going to be something like 3 billion new smartphone subscriptions in Asia and Africa in the next 5 years. And you go from this point where people have had to try and deliver services over Nokia bricks or feature phones, which is really tough. I mean, if you go to the CEO of a digital business and talk about trying to build a great customer experience over that kind of handset, that's a really difficult thing to do. And suddenly you go to this point where everybody will have essentially supercomputers in their pocket. And this is a group of people who have never had, as I say, healthcare before, haven't had education before, financial services. And as far as I'm concerned, that creates a huge opportunity for people to develop new, affordable services of that type delivered over the smartphone. And if you think about how smartphones changed the economy in the West to the point where, I don't know how big the app economy is, I think some people call it $4 or $5 trillion, something like that. There's this big opportunity now where you have maybe 4 billion people across Asia, Africa, and Latin America to some degree, and suddenly you can design those kind of products, those kind of new business models. And I think we'll see a lot of really big businesses coming from serving that unmet need over the smartphone, regardless of what happens with data costs.
Okay, I'm going to open it up to the floor in just a second, but one last final question briefly from Rahul and Sonja. We talked about the opportunities, the big opportunities. What are the big challenges? And I'm thinking, Rahul, of your call on Vietnam and factories. You know, technology is a huge threat to that. There was a story, I think, on Bloomberg the other day about Bangladesh and, you know, the technology that is meaning these factories are taking on far fewer workers than they used to. You know, how much of that is, and you know, what's the biggest threat to your view?
Yeah, no, I mean, I totally agree. So in terms of, again, my fund's mandate, I do have an ESG mandate. And so the environmental aspects, the sustainability aspects, the governance aspects become particularly important as I look at frontier markets. So, I mean, the example that we talked about, for a lot of factories moving from China to Vietnam, there could be a pollution-related reason why it's moving as well. So we do need to monitor that. Governance as well. I mean, you know, we've talked about financial inclusion and M-Pesa and, you know, telcos in Africa, and, you know, that's a space I look at quite closely. But, you know, with the example of, you know, MTN in South Africa operating in Nigeria and then being fined $5 billion because, you know, they weren't in compliance with some of the anti-terror regulations in Nigeria. I mean, that's something that as a fund manager sitting in London would keep me awake at night. So we do, I mean, I think investing in frontier markets comes with its own challenges around governance in particular, which I focus a lot on.
Governance is an important point, and on a similar note, I think a lot of these new technologies, fintechs in general, fall into the category of, you know, move fast and break things. You know, and this is from a regulatory standpoint, this is a difficult challenge for frontier market regulators in particular, because they're dealing with millions of first-time users, right, for technologies that are very different from sort of branch-based banks. You know, so that poses a set of difficult questions on the balance between stability and allowing these innovations to blossom.
Right. Thank you. We'll go to questions, and could you just raise your hands if you do have a question, then we can get through it efficiently for lunch purposes. David.
David Burnside. Let's assume for the sake of this question that let's discount the benefit to a country of international aid having some soft power diplomatic benefit. In your decision-making process at a micro level in frontier markets or the micro level in actually investing in companies, has it any relevance at all in your decision-making process?
Sorry, the question was around the impact of... Yeah.
Yep. Yeah, well, look, I mean, let me say a couple of things about that. I mean, first of all, I can tell you very directly that Leapfrog would never have got off the ground if we hadn't initially been funded by, not DFID, actually the EIB, I'm sorry, so the European Union gave us our initial funding, and we simply wouldn't have got started without that. We then got money. I think our first big institutional investor was the IFC, which is incredibly important in the markets that we operate in. And I could give you examples of any number of really important financial services businesses across Asia and Africa who have scaled or serving a lot of low-income people with microloans or affordable housing schemes or whatever it might be, who got their start from being funded by the development finance institutions. And I think the big challenge, of course, is that people in the UK now, they get all this stuff in the media about what a terrible thing aid is, and it's all parties in Haiti with prostitutes. And of course, they never get the counter-narrative of that, which is all the incredible work that the development organisations do. Is it important for the UK politically to do that? I mean, I think it is. Certainly, it's important for us as an investor. If we are partnered with, for example, the IFC or DFID, that does give us a huge amount of protection, particularly with regulators. So we feel much better protected against adverse regulatory interference if we're partnered with governmental investors, for sure.
And I wouldn't discount the risk mitigation factor too, right? I mean, when we talk to investors about putting money, for example, into frontier or emerging market infrastructure, part of the way that's possible is by the risk mitigation offered by organizations like the World Bank, and other that investment wouldn't exist otherwise.
Okay, question there.
What role might Bitcoin play in development and as part of the opportunities? You talked about the sort of whole mobility question of some of the micro opportunities. So what role might Bitcoin play?
I was just going to say that rather than Bitcoin specifically, the blockchain technology can, I think, offer a lot of benefits in terms of security and anti-corruption measures. If that secures the type of payments, for example, or transfer payments, that can have helpful benefits there.
Yeah, I would say similarly, not necessarily the Bitcoin bit, but the blockchain. We are working where we are using smart contracts in certain markets. So there is a transparency around the transaction base. So again, it's the use of blockchain for that rather than the Bitcoin.
Okay, gentleman towards the back.
To what extent do you find that the governments are stepping up their business environment to try and make it possible for some of these businesses to flourish? Because a lot of the time in African countries, the business environment is still quite difficult, which is why even locals aren't really investing in some of the businesses.
Well, in electrification, we see progress. So we have seen a step change in roughly the past 3 years. So the number of people getting their first electricity annually increased by a factor of 2-3 in just a couple of years' time. Now the most successful cases, like the countries I mentioned, Kenya and Ethiopia, are the ones which combine two things. One, for certain things will not be leapfrogged. For certain things, the government has to do its homework and lay out the basic infrastructure. And I would also that in most of these countries, there is a state-owned electric utility which requires a very deep governance reform and very deep management reform. And when you combine those things which the government can do, of rolling out the infrastructure backbone and reforming the national electricity company, while enabling the new innovative solutions like the mobile micropayments for solar in Kenya, which is a real success story, and you combine these two, then you can make a very significant progress.
Okay, well, thank you. We're out of time. So just before we break for lunch, I need to let you know that the people wearing the purple lanyards are from the IIF. People with the red lanyards are from Exotix, in case you've got follow-up questions, on research, anything like that. I want to wrap up by introducing the co-host for today's event, the CEO of Frontier Markets Investment Bank, Exotix Capital, Duncan Wales. And Duncan is someone who has kind of experienced frontier markets from a lot of different aspects as a banker, a lawyer, Standard Chartered, ICAP, ING bearings and also as a British commanding officer in places like Africa, Central Asia and emerging Europe. So I want to thank the panel very much for a fascinating discussion and welcome, Duncan. Thank you.
Fantastic panel. I think you'll agree, and in fact, fantastic panels all morning. So, really interesting speakers there. And thank you, Gavin, for that kind introduction. Makes me sound much more exciting than I am. We've covered a lot of ground this morning, which I don't even I won't even attempt to sort of retrace. But there are a few high-level themes that I think are really pretty interesting to what we think about the investment case and the investment decisions around frontier markets. And in fact, I'll come back to that whole sort of issue of what is a frontier market at the end. Demographics is one of the issues I think we've all sort of touched on and alluded to, but haven't necessarily addressed front and center. If we think about the developing markets more generally, it is really most of the people and most of the physical space, habitable space, and natural resources of the planet. We know that Africa is very likely to be the fourth great demographic shift of our era, where, you know, knocking on 50% of the people are 18 years of age or younger, and that is going to be highly consequential. But we even have touched on economies like Saudi Arabia, where 2/3 of the people are under the age of 30, and we know Vision 2030 is not just an economic program. It is a pretty profound political revolution in its own way. LATAM, South Asia, Southeast Asia also are very high on the sort of population growth, but also this very youthful population. And that is a youthful population, as we touched on in the last conversation, who now have cell phones. Because the next real big issue that we've been talking about all morning is technology. And what technology can do. Technology is being democratized at some speed to the extent that I find myself in New York, I can't get a signal on my cell phone. I found myself up in Laikipia in northern Kenya a couple of months ago. Perfect reception. It's a pretty good example. So when we think about some of the challenges posed by how quickly demographics are changing, and then we think about some of the opportunities that technology will give us, I think we start to think about things in a slightly different way. Cellular technology, as we were just discussing, combined with something like blockchain, distributed ledger models, where you have simultaneous multilateral confirmation of fragments of information, can quite swiftly transform a population that hasn't got a social security number, doesn't have medical records, isn't part of the tax net, and has to rely on a cash economy, into all of those in one step. So the potential disruptive effect in a lot of these fast-growing economies is substantially different, of a completely different magnitude and order to the developed economies. You know, where we already have those things, we're going to have to take out a load of technology and replace it with a better piece of technology. Clunky, expensive, a good idea, but not the same disruptive step forward. Again, thinking about what mobile technology can do, M-Pesa in Kenya is probably the best known example of a mobile payment system, but there are multiple systems like this around the world. And in fact, what we see is almost a convergence of conventional banking and telecoms provision, which is very strange. It's going to pose a lot of regulatory challenges, no doubt, but it means you don't actually have to have a bank account, which is a strange idea. But it does mean that you can create an entirely swift, much swifter era of financial inclusion. And the other thing, by the way, although it is very nascent, that we should say is that we are seeing pension funds emerging in the developing economies, albeit right at the beginning of that process. And they are trying to invest in both equity and debt instruments and domestic and hard currency. Okay, so we've also talked about what rising dollar rates might mean. We should think about what rise of dollar rates might mean, combined with a greater degree of confidence in the domestic capacity for domestic currency instruments, because I think that is another one of the themes that we will see increasingly. The next thing, again, we've sort of touched on, is the unfashionable notion of commodities. And I think we've moved away from the iron ore, coal, oil and gas version of commodities into something a little bit more subtle. With, oil and gas has come back. I would actually separate them now, because the technology around natural gas is such that natural gas, as something you can offtake and create a bit of hydrocarbon, clean-ish hydrocarbon offtake, is something that we're starting to see. And in fact, it will be a pretty big political test for countries in the developing economies to see whether they still think about export or if they think about increasing the domestic offtake as their economies drive. We touched on cement as well, which is one of our pet subjects. China, one belt, one road. That belt and road, all the physical bits of infrastructure are probably going to be built with Pakistani cement. Okay, we start to see these things happening. The next thing that's been one of the themes that we've been talking about this morning is political shifting. Now, politics goes on all the time. Political risk, yeah, it sort of exists, but often quite dissociated from some hardcore investment decisions. However, we're starting to see some really quite interesting ones. Zimbabwe. 5 years ago, would we have expected Robert to go quietly? Would we have seen Jacob go on his coattails, quite frankly? And I wonder if Zuma's exit would have been as neat if Mugabe's hadn't gone the way it did. Also, 5 years ago, if somebody had said to you, in 2017, the Argentinian Republic will issue a 100-year bond and it will be thoroughly oversubscribed and the Tajiks will do one, and we would have said, yeah, I'm not sure I can buy that, but everybody did. Saudi Arabia, touched on it quite a few times. Okay, it's going to be a really fascinating test case of how to go from an oil and gas economy with a youthful population who are predominantly underemployed and who live in 1970s social housing, transfers itself into something else without the House of Al Saud having a really significant political problem en route. That will be interesting. PRC, China, one belt, one road, touched on it. The belt and the road obviously lands on frontier markets. And much as we all think of ourselves as part of the investment community that really lives in the developed market sector, the other natural big investor, both at the government and increasingly at the sort of corporate end, is the PRC. And again, we touched on that and the potential surprises China will have when it joins a conversation about a default in Venezuela or wherever it happens. The other big political shift is perhaps a more subtle one, which has been going for perhaps a bit longer period of time, which is the gradual withdrawal of the US as global supercop and global economic thought leader as well as actual leader. The last time the world's only global supercop decided it needed to back off being global supercop was just over a century ago, and it didn't go so well, as I recall. So where does all this leave us? I think it probably leaves us with a slightly more complex, subtle, refined, but in its own way more informed and more accurate vision of what we mean by some of these developing markets. And I say developing markets deliberately because I also think that we might be at an era where the separation between what is a frontier market and what is emerging markets is somewhat blurred. I think it will just be more complicated than that, it will be more subtle than that, and it will change potentially faster than that. The big multi-billion-dollar businesses of the future, the perhaps very imminent future, are not going to look like those of the past. They may not even look like Google and Alibaba. And so I think we are very likely to see an era of change that is more fundamental and more significant in the next limited number of years than the last 20 has been, despite the huge changes of the last 20 years. So it's incredibly exciting. It is not without risk. but it does feel as if there's significant opportunities in this market, and I say we'll have to manage as an industry and as a body, politic and social, the reality of those changes. So finally, I would just like to thank everybody for coming. I've really enjoyed this morning's debates and conversations. Thank you to our speakers. Thank you to Bloomberg for hosting it in this incredibly glamorous location. It's so glamorous, I fully expect a discount on all my terminals imminently. To the IIF, who have been fantastic, and to my colleagues at Exotix Capital, and to you for attending. I hope you will have the chance to join us for a buffet lunch that we're now having outside, but thank you all very much.